So somebody from your group might kick this thing off.
You will be the owner of the fund.
Yeah, I'm going to keep the introduction short, so anything you say about me, people know who I am. This is Cox and Moderators.
I will just thank everybody, welcome everybody, and then I will give you.
Okay, good.
You should.
Oh, this is terrific.
Que estén.
I'm done.
Black Bear.
Yeah. Why is this not working?
Jim, what's your area?
I'm in the corporate security area.
Okay, good.
Been at Duke for 30 years.
Great, great.
I hope I don't need it. Exactly, yeah.
Out of it faster.
And last longer.
Yep.
It lasts longer here.
No, it lasts shorter here.
Yeah, we get out faster. That's right.
We get out faster.
That makes sense.
No,
We get out faster, and they're getting into the cycle longer after.
we're gonna. Although they got into it pretty fast this time. They got very fast because of the drop off in lending when Wachovia started to have trouble. They're the principal export bank for the world. It's interesting.
Okay.
They cut all their.
Thank you very much for being here. In the name of the Latin America Business Law Association and the Latin America Students Association of the Fuqua School of Business, we would like to welcome you for being here. Thank you very much for all of you. I would like to thank all the speakers that we have, all the firms that sponsored us, our professors, Professor Cox, Professor Brown, Professor Kielmanovich, and especially I would like to thank Judy Horowitz and all the law school for all the support they gave us. And I cannot end without especially thanking all the students. We made an incredible effort, and I would like to especially thank to all the students in the name of Francisco Prat, that he was one of the main responsible students for this symposium. So thank you very much for being here, and let's start that we are a little bit late. So the first panel will be introduced by Professor Cox. So thank you very much and enjoy our second day of the symposium.
Well, following on those thanks, we thank the student leaders for this organization for following the giant footsteps left for the crowd in front of you and doing such a good job, it appears, so far. So I welcome all of you taking time out of busy careers and busy lives to be here. We're going to have the introductions just precede each of the first one. The first speaker will be Bill Brown, who, for those students here who needs no introduction, Bill has had the sort of encyclopedic life, has a science background, partner on Wall Street at Sidley and in a firm before that. A long career in Wall Street with Goldman Sachs, and then followed by Morgan Stanley. And we welcome him back as one of our grads here to inflict pain on each of you, not because he's a great teacher. He just demands a lot, I understand, and those are the best teachers that come. So, Bill, welcome.
Great. Thank you very much. This particular room, I'm particularly happy to be in because many of the students here, I've spoken to you in this room on a number of occasions. I teach M&A in here. I've taught essential analytical techniques in here. I've taught a few things in this room, so I'm happy to be here, especially in this room. Everyone asked me to put together something on the financial crisis and the way it sort of leads into Latin American and emerging markets more generally. And I've thrown together some slides. I've got a lot of things here, a lot of ideas. And my thought is, at first, is to start out broad, 30,000 feet, maybe even from some people's taste, maybe I'm at 80,000 miles. but doing business in Latin America, financial crisis, challenges, and opportunities. I wanted to start out, how did we actually get here? How did we actually get here? Sorry. This was a graph that I saw about 2 or 3 years ago. And it was a graph that was in the speech of the governor of the Reserve Bank of New Zealand. It was a speech. It was a chart that he had. And it was published, and it didn't get that much recognition around the world. And the only place you can find it is on the RBNZ's website. But it's really curious, and this is 2 or 3 years ago. Look what's going on here. This inverted pyramid. It starts with the bottom 2 layers, power money, traditional money supply concept. The next to the bottom layer is broader money. And then the next 2 layers, securitized debt. By that they actually just meant debt that has securities attached to it, things that we normally think of as debt. And then this top layer, derivatives related to debt. What's really curious is that how big the shadow banking system got. You can see here they added this up. 11% of liquidity was from things we normally consider liquidity. Another 11% came from things like commercial paper, medium-term notes, things like that out in the market. And finally, you got 78% on this very top layer, derivatives. These are all the alphabet soup that we all hear about. Mortgage-backed securities. These are CDOs. These are CMOs. These are all these, asset-backed CP. It's all this sort of funny stuff. When you look at it over here on this left side, and almost look at it on a sort of velocity of money type concept, and gauge it by the size of the world GDP, you can see only a small amount here is roughly 11% of world GDP, but the rest of this is something closer to 11 times world GDP. Big number. Big number. A lot of this stuff has been destroyed. A lot of what happened here was we had derivatives. We had CDOs that actually allowed people who never ever invested in mortgages, people who never ever thought that they would invest in mortgages, but because the S&P and Moody's said it was AAA, we gave them a license to use these vehicles to take their money and put it over into mortgages. We gave them a license to put money into credit cards. We gave them a license to put money into automobile loans. All because none of this was called mortgages or auto loans or whatever. It was through a separate type of security. So that's part one of the liquidity flood. We had stuff moving into this market from sectors that had never ever invested in parts of the market. Next part of the liquidity flood came from the global imbalances. We all know global imbalances. We talk about it when we talk about China. Many people talk about, well, the reason that we buy so many goods from China is because we don't save in this country. And in essence, China, let's face it though, if the US did not exist, China would have had to invent it. Okay? China needed someone to buy all the goods that it was wanting to manufacture. And the best synergistic arrangement was then put into place, almost by accident. China sold us goods. They took the money that we gave them and they put it back into our credit market. And by that cycle, they helped push our interest rates down. And they made it easy for all of us here to go out and buy more goods. Credit was cheap. Money was flowing. So that's the liquidity flood part two. And in addition, we add to this international reserves. This is what you see the IMF publishing here. Right now we're up to around $7 trillion worth of international reserves. And then on top of that, you add $4.4 trillion that represents reserves that have been swept off the table, no longer called reserves, and put into these things we call sovereign wealth funds. So big source of liquidity there. Now here's the part that fewer people understand, but I think you can understand it. It's called the carry trades. And carry trades exist in all sorts of forms. Essentially, it is borrow cheap invest at a higher rate. Borrow cheap, invest at a higher rate. That's a winning story for success. In fact, it happened a long time with Japan. People would borrow in yen with the interest rates very, very low and buy dollar assets. And you see, here's the spread. This shows the spread between US and Japanese interest rates. The spread actually in 2005 actually got up to 5%. That was a safe trade in a way because Japan had an avowed policy of keeping their exchange rate stable. They did not want to see the yen strengthen. Because let's face it, if the yen strengthened and you were short the yen, you lost on that one. But because you basically had government-sponsored arbitrage in this particular situation, this trade worked, and you could make 5% on your money. Other ways in which you borrowed low rates and invested at higher rates is the traditional way that banks have recapitalized themselves. When short rates are low, they borrow low, and then they buy 10-year securities, longer-dated securities. There are other examples of carry trades all throughout the market. People found ways of borrowing at a low rate and investing at a higher rate. And the banks, the hedge funds, and the banks all facilitated these trades. We all had a financial system. Again, it's going back to this. We all had a system that allowed this to happen away from the banks. Now, to this mix of all this liquidity, you have to mix in moral hazard. We didn't get here without moral hazard. Now, let's start with Alan Bubbles Greenspan. Alan Greenspan, every time, his job was supposed to be, as one central banker said, was to take away the punch bowl right when the party was getting underway. Instead, all indications are that Alan tended to spike the punch. And right when we thought things were getting bad, rather than make us face our medicine and take our medicine and go through a corrective cycle, every time we started getting to the bottom, every time we started get to a correcting part of the economy, he goosed rates again. Let rates fall and kept us away from the bottom of the cycle. Bank compensation schemes, big moral hazard, and we see this popping up all the time right now. People are compensated for short-term returns, but they never have to bear the long-term risk associated with their decisions. There are people in the banking system who went out and got paid millions of dollars simply by putting on mortgage trades, and yet, now that those portfolios have blown up, they haven't had to give a single penny back to the bank who compensated them. Securitization. We've already talked about securitization. That's going back to slide 1. That's the out-of-sight, out-of-mind problem of moral hazard. I don't know that I'm investing in mortgages. I don't know that I'm investing in credit cards. I'm simply investing in a AAA security that Moody's told me was safe. Out of sight, out of mind. Then there's if someone's willing to pay me more basis points for a AAA security than a normal AAA security, my first reaction should be, it's too good to be true. It's too good to be true. People should have known this. AAA securities, paying me more, sort of like light beer. Tastes great, less filling. But what happened was, and the reason everyone ignored the it's too good to be true problem was because everyone else was doing it. I'm not going to pull back on my investments in mortgage-backed securities. I'm not going to pull back on my programs to put CDOs and CLOs together. Citibank's doing it. Why should it? They're doing it. It must be okay. Deutsche is doing it. It must be okay. Morgan Stanley's doing it. It must be okay. So the too good to be true got overwhelmed by the everyone else is doing it. Finally, reliance on models without understanding. Most of the CEOs of a lot of these banks out there had no clue what a CDO was, I'm ashamed to say. They had no clue. They could not sit around and engage in a responsible discussion of the tail risk. They relied on other people. And that helped get us into the problems. And no one ever told them, and they never asked the question, how good is the model? You know, there was John Kay recently wrote an editorial in the Financial Times where he said, you know, the one line in there that's great was, you know, models are good, but they need a human being to exercise discretion on top of them. They need a human being to sort of say, it's almost like just because my car can go to 160 miles an hour doesn't mean I should go there. Now, to this mix, we add deregulation. There was a belief that markets would impose discipline. We didn't have to regulate people. There was a belief that rating agencies would serve as a check. There was a belief that Basel II banking standards would limit the risk. There was a belief in self-regulatory organizations. Conclusion, regulators weren't necessary. Markets would regulate themselves. There's several warnings, though, that this could be a problem. We actually had some warnings in the mid-'80s with Boesky and Milken in that era. I mean, we did have warnings that some of these too good to be trues and, you know, easy money could lead to problems. That clearly happened in the mid-'80s. Furthermore, we had problems in the S&L crisis. Deregulation is directly responsible for what happened in the S&L crisis simply because we let S&Ls invest in things that they couldn't invest in before. And those were the things that got them into trouble. Now we add obfuscation to the mix. You know, we've already talked about securitization means that investors don't know what they're buying. Risk management fails when interrelated assets mean that they can act in unforeseen ways. We had this happen several times. Lowenstein talks of complex relationships when he's writing his book about LTCM. Booksaber talks of complexity and a demon of our own design. Taleb talks of black swans, and the black swan, the impact of highly improbable. Essentially, all these are ways of saying that stuff happens. And you know, I probably wouldn't use this, and that word is not the word I would use if I were talking to you privately. So I call this, not complexity, none of this stuff, I call this the hubris effect. I mean, basically, investors and risk managers think that they understand things that they don't, or that they don't need to understand things that they don't. Some saw it coming. I mean, we get this question all the time. Well, why didn't people see it coming? I mean, many banks had senior economists who were actually publishing papers saying that this is a problem at the same time that the CEOs of those banks were making decisions to continue these programs. Those papers exist in print. You had risk managers in banks were predicting the problem. But again, this goes back to another thing that's very common is no one wants to hear a Cassandra. No one wants to hear someone tell them why they shouldn't be making all this extra money, that there's risk associated with it. They'd rather simply believe in the crowd, that the crowd is right. There were bank leaders. I don't know Jamie Dimon, I do know Lloyd. Jamie has a history, though, and it's documented. When he took over Salomon Brothers, he actually got rid of the Russian debt. And that could have been one of two things. One is or it could have been three things. It could have been he objectively decided that Russian debt wasn't something you should be investing in. But the way the story goes, it's more likely that he didn't understand it well enough, and so therefore he didn't want something in his portfolio that he didn't understand well enough. Or possibly that he just felt that it wasn't a match for the sort of risk levels that they were taking. Maybe he understood it, but it wasn't part of their risk levels that they wanted. Blankfein, on the other hand, at Goldman Sachs, I mean, if you look at what they did, their trading errors were very few. Their big problems, Goldman Sachs' big problem, quite frankly, was the collapsing economy, not because they put along a lot of trades. They took off a lot of these trades that got all the rest of the banks in trouble. Various hedge funds also saw it coming. I mean, obviously, famously, Paulson and company saw it coming. How bad is it? New York Times had this chart, worst decade yet. Banks have barely started lending. This is a chart of the excess reserves as published by the Federal Reserve Bank. If I took this chart all the way back into the 60s, you would see no blip on it. Right now, you're seeing that little .com blip. But all the way back into the 60s, if we put it over here the way that Al Gore would have put this chart across the screen, this would have been flat all the way over to that wall. And yet, what you saw here is this is the Federal Reserve pushing more and more money into the banking system, more and more money in the banking system. This is money that they could have loaned out, but did not lend out. In the last 2 weeks, it's actually fallen. So 2 weeks ago, I would have said banks had not started lending, but now I can say they barely started. A lot of people hear me say this. People heard me say this about back in September, and they laughed at me. And they said, no way that we're like Japan. And they pointed out all the differences between us and Japan, but I think there are similarities and there are dissimilarities between us and Japan, but most importantly, we can learn a lot from Japan right now. Here's the scary slide. Slide has it has a double entendre on this one. This is the Nikkei coming down through here. The Nikkei fell 67% from its peak. Property prices fell 50% in that period. That's scary. That's Japan over roughly a let's see, 18-year period. What about LATAM equity? What about what we're here to talk about? Well, it's actually done reasonably well. I mean, this column here these are various stock indices that we all recognize. And you can see this is the 52-week change in these stock indices. Actually, Mexico and Brazil down 30-odd% in local terms. This over here is the currency impact included. But in local market terms, it's pretty much in line. I think a lot of people would think that LATAM would have done worse. And I think that what they're doing, they're thinking of the currency effect there. What about emerging market debt? This is a more complicated, these are two slides. These are complicated. I use credit default swaps because credit default swaps are actually easier to measure the spreads. And you actually see two columns here. This is DEC 31 last year. And you can see, for instance, Argentina's gone, this in effect implies 3,900 basis points above U.S. Treasuries. Okay? It's actually done better. It's only now 2,900 basis points. Take Brazil, 500 basis points spread out a little bit. Colombia, spread out a little bit. Here's the surprising one. USA. Look at this. The USA actually has credit default swap spreads now, which is really curious. So those are credit default swaps. So the debt is not doing as well. That was my daughter. Sorry, sweetie. Reinhart and Rogoff had just done a study on for the National Bureau of Economic Research. And they looked at two different types of crises. They looked at banking crises, which is the red line here. And the banking crises are, you can see a proportion of countries with banking and debt crises weighted by their share of world income. And so they went back. This is 1900 over here. And obviously this is the teens. And this is the 30s. And then here is the 80s and 90s. You know, part of this, the 90 piece here, a large part of this is Japan because obviously it was, has a large market cap weighting in through there. But their conclusion here, which I'm not sure that I fully agree with, but I figured I might as well throw it up here because they said it boldly. A high incidence of global banking crisis has historically been associated with a high incidence of sovereign defaults of external debt. Now they're doing this because certainly we saw this banking crisis precede this, in the blue lines, the external debt crisis. And here we have our little 80s episodes. And obviously now we're actually at a very sweet spot on external debt. But if you listen to these guys are suggesting that now we're back up, that we may be seeing global external debt crises starting to come in. I go to the Dallas Fed has recently done a study. Also, this was November of last year. This is on developed markets, but it's somewhat instructive. Several things are happening here. They're looking at this from the U.S. point of view. They're showing that, and the whole question that we're trying to deal with here is the U.S. People used to say, when the U.S. catches a cold, the rest of the world gets the flu. And so that's what this study is trying to address. And it's saying, well, the world is less interrelated with the U.S. I mean, you can see the exporting countries, this is the percentage of total exports to the U.S., we're actually falling off. So people, this is the, you've got France, you've got Italy, you've got others, Canada is into here. You obviously see Canada coming down here. It's much less interdependent with the U.S. And then they look at, this is the correlation of business cycles. They're saying that business cycles are becoming less correlated with the U.S. They're saying that they then go on and say that as U.S. business cycle weakens and stabilizes, that it sort of, the contagion effect, it goes on to other countries. And I won't go through this, but essentially what they say with all this is two things. It used to be when the U.S. catches a cold, the world gets the flu. And now, a couple things are happening. One is there's a longer delay between what happens in the U.S. and what happens in the rest of the world. And second, when it does hit the rest of the world, it's longer lived. It actually lasts longer than happened in the U.S. So as I say, this is a developed market study, but I actually throw this out there as just a potential issue as we focus on developed markets. And between this study and between this study, the question is, are we looking at some debt problems here that are unexpected? Conclusions. I think emerging markets are showing great resilience in the middle of all this. We're not out of the woods yet. The U.S. economy can slow further. The banking system's not really fixed yet. Commercial real estate has yet to collapse, really, and it's going to collapse, and it's going to collapse big. And the stimulus bill might not stimulate. We saw what Reinhart and Rogoff suggest. We saw what, and the final thing I leave with you, there's a possibility in through here, and this could be the thing most to worry about, that there could be a U.S. debt crisis. Remember, when we started this out, that we talked about China and how we rely on the world to help us finance ourselves. If the world loses confidence in us at this very critical moment, the fact that we've taken on all this extra debt through the stimulus bill, the fact that we've taken all this extra debt through the banking bailout packages means that the fall could actually be pretty large. So that is the one thing. If you want to know what keeps me up at night, it's that final point. So that's it.
Thank you, Bill. I knew you would cheer me up. And now all of us will be up late at night. Our next speaker is Andrew Qualley, and he had spent his educational career in an obscure small college in Cambridge, Massachusetts, both undergraduate and law school, where he had a very distinguished record at Harvard, and did the unusual thing at that time, I can speak from that generation, of instead of following the sirens to Wall Street, which he ultimately did, when he graduated from law school, accepted the very prestigious Knox Fellowship and went to England to study for a year. So much to his credit, he already had an international vision at that point, and spent his career with a partner at Sidley and Austin in many areas of international finance. And among his many outside activities was being the draftsman of laws at other countries, and one of which was Colombia, and also just to show that he covers other continents, was also in Indonesia as a draftsman there. So we're very happy that Andrew took time out to come and join us today. And And we were just talking earlier about whether Bill cheered him up with PowerPoints like he did us here as well, because their tenure at Sidley overlapped.
Thank you, Jim. I'm not sure if my slides will appear. Probably not, and it's not necessary. You can do it? Okay. I may call on you to provide some technical assistance. A couple of personal notes. Bill and I go back a long way. Bill worked with me at Sidley Austin on international debt restructurings and reschedulings. And second, at the back of the room is Nora Gillis Bynum. And Nora Gillis Bynum's father was dean of the faculty here a number of years ago, but more significantly, Malcolm Gillis and I worked on a big tax reform in Colombia and then on a big tax reform in Indonesia, as you said, and I met Nora when she was 6 years old in Bogota, Colombia, and we both survived Bogota, Colombia. So it's a real pleasure to be here. This is a timely time to be worrying about these issues, and you all are lucky to have the opportunity to be students or entering the job market, assuming you can find a job, to deal with such exciting issues. A couple of days ago, the Wall Street Journal says Obama warns of lost decade. Which lost decade is he talking about? Any ideas? Japanese? Possibly. The lost decade in Latin America? Possibly. He's talking about the next decade. The next decade, our decade, your decade. What's really fun for me is there was a guy, a lawyer from New York, who gave a speech a number of years ago in about 1987, and the phrase "the lost decade" was coined in that phrase, in that speech, and I coined the phrase "the lost decade," but I was referring to Latin America. And Latin America lost a decade, a whole decade. Growth was zero for 10 years. If we had zero growth in the United States for 10 years, we'd have a revolution. I don't know what will happen, but Bill is obviously worried about that same issue. Okay, I thought Bill's presentation was terrific. I agreed with all of it. I would put even more blame on Wall Street, but that's all right, and the hubris. And I would have had a little slide that talked about credit default swaps, because the Fed says there are $64 trillion of credit default swaps guaranteeing $2 trillion of underlying debt. That means $62 trillion of that is sort of speculative gambling, but that's something that we can debate about. But it's a fascinating number.
My eyes are blinded to gambling.
Okay, I'm going to talk a little bit about the view from high up, but then try to get down into the weeds. Today, I think the global economic crisis that we're facing is extraordinarily severe. I'm going to talk about the impact on Latin America and its relevance to you as lawyers or business people or bankers. In terms of the impact of the crisis on, shall we say, corporations, and then we'll talk a little bit about governments, we have enormous failure of banks and the banking system. Credit has dried up, seized up. That means good businesses, even good businesses, can't get credit. Third, falling demand for products, whether industrial products or consumer products, means profits are plummeting, losses are rising at dramatic speeds. Cash flow has disappeared for companies. What does that mean? They cannot pay their loans or their bonds as they mature. What's the option? Well, we're going to talk about that. International trade has also dried up. How is Latin America doing? Bill and I also are somewhat on the same page there. actually better than one might expect. Better comparative, say, to the United States. Even Latin America and the emerging markets might be the engine for pulling us out of this crisis, whereas traditionally it's always been the U.S. that pulled us out of these crises. But let's take a look just a little bit at Brazil. Plunging commodity prices. That means iron ore, steel, soybeans, sugar, ethanol, pulp and paper. 40% of Brazil's exports come out of commodities. Beef packers, meat packers, collapsing. The export trade in meat from Brazil has collapsed. Who is the largest importer of beef from Brazil? What country? Any guesses? Not the U.S. Japan? No. China? No. This is really amazing. No. Argentina? No. That deserves a lot of credit. Russia, the largest importer of beef from Brazil. Guess what? They're not importing beef anymore. So it's back to potatoes and vodka. And that means meat packers in Brazil are having to restructure and reschedule their debt. Brazil has also suffered from the derivatives problem. Wall Street brought these wonderful ideas to Brazil. They sold them on foreign exchange derivatives. Instead of using it just to hedge their export earnings or their import costs, they just gambled. So now there are an enormous number of Brazilian companies that have to pay on their their foreign exchange derivatives. Aracruz, big-time loser in that, has just had to reschedule all of this debt, hundreds and hundreds of millions of dollars, and they're rescheduling over 9 years. And what do they have to show for that? Zero. It was just a bad speculative bet. And now that's burdening them for the next decade. Trade credit has dried up totally. And this was the last item of credit that you ever saw problems with. Wachovia was the biggest trade bank in Latin America. They're not lending. I don't know who's stepping forward, but that has an enormous impact on countries like Brazil to continue with their productive capacity. That's the bad news. The good news is the banking sectors in most Latin American countries are doing well. One banker, a Deutsche Bank, said when I was in Brazil last week, he said, the Brazilian banks may be the best banks in the world today. This is very unusual. It goes to Bill's slide about what creates crises. Is it sovereign debt? Is it foreign exchange? You didn't mention this, foreign exchange crises, or is it banking crises? And it's usually precipitated by a banking crisis or foreign exchange crisis, and then you have maybe the sovereign debt crisis. So I agree with you. Rogoff is a little bit off on that. We'll come back to Rogoff in a minute. So the good news is the banking sectors are much better shape in Latin America, and this is usually not the case. Not the case. Capital markets coming back. Last week, Petrobras, Codelco, Pemex all issued notes in the capital markets. Several weeks before, full sovereigns did. These guys are called quasi-sovereigns. That's really good news. What's unusual about that is that normally the first lending that comes back is bank lending, not capital markets. Why do we have an unusual situation? Capital markets rely on institutional investors. Institutional investors, in fact, have money today. They're just scared to use it. So they're sitting on it, making 0.1% in U.S. Treasuries, but ultimately they have to pay pensions, they have to pay insurance, medical costs, whatever it is. So they got to put this money to work, and they're gradually starting to put it to work. Banks are out of the lending business. Why? because either they don't have capital, or if they have capital, they're keeping their powder dry because they know they're going to have to write down more bad loans, and so they can't afford to add new loans onto their books and then have to write down some of the toxic waste that they have. So that's why we have a little trouble on the bank lending side. Okay, if we have so many, we're getting into the weeds now. If we have so many companies that can't meet their obligations as they may become due, what are they going to do? What are their options? One is raise new capital. And I'll come back to that in a minute, but there actually is some new capital going into Latin America in the form of private equity and strategic capital investors. Second, you've got to restructure or reschedule that debt. Third, in the case of bonds, we have a different process that we'll talk about. The next option is default. Argentina is really good at that. They've got that down to a science, followed now by Ecuador, and someday soon probably Venezuela, and then bankruptcy. And in the case of sovereigns, we know sovereigns don't go bankrupt. That was Walter Wriston of Citibank. He suffered other problems. Okay, so bank debt. The traditional approach. We're going to go now, before I leave this slide, this is a speech I gave at the ID meetings in Milan in 2003. And Ivan was at those meetings. He didn't hear the speech. And this was to the CFO, the CEOs of the major Latin American banks. So it's tilted towards banks. But the first paragraph says, many obligors, private and sovereign, throughout Latin America facing great difficulty in meeting their obligations. What's going on? It's 2005, 2003. So every 5 years or so, we have crises, right? So the good news is we can recycle our ideas. And also the good news is we'll get out of this problem, we hope. But I will have to say, in 2003, it wasn't nearly as bad as it is today. I will go to page 3. How do we restructure debt? Syndicated bank loans, they're almost an anachronism today, but that's what we had to deal with not too long ago. And there were a group of sophisticated bankers. They all worked together. They'd sit around in a room. They'd argue a long time, and then they'd finally work out a restructuring with the borrower. We did find a problem, next page. We did find a problem with what we call rogue lenders. What that meant is that one lender, by refusing to agree to an extension of the term of the loan or a reduction in the interest rate, could jettison the whole restructuring process. And this was a serious problem. What we then did is we came up with this little idea, and I think that's in the next slide. No, go back. It was called a forbearance agreement. And that only required 2/3 vote. So you had 2/3 of your bank debt under a loan agreement agreeing not to sue, not to accelerate, not to foreclose. That would give the borrower a period of time to work things out, and it would isolate the individual rogue lender. Now, the rogue lender could, if a payment was missed, sue on that one missed payment, but the rogue lender itself, on its own, could not accelerate the entire indebtedness. And so this is legal engineering at work, and it generally worked pretty well. Some courts didn't like this. They said it was tantamount to taking away the power of a single lender to object to an extension of the term or decrease of interest rates. But most courts said, no, this is okay. All right, the next slide. Bonds, very different problem, particularly if the bonds are publicly held, i.e. through public registration. They might be held by thousands of investors. It's very difficult to restructure the thousands and thousands of creditors. You can't even get them into the same room. So the steps that are used for restructuring of bonds are more or less three. One is, and this is going on right now today, if the borrower, the debtor, has some cash, it slips into the market and buys up some of its own debt at deeply discounted prices. Now, some bond indentures will preclude that, say the obligor can't buy back its own debt, and of course you get away with that by simply having somebody else buy it for you, and but we don't talk about that. The second thing is you can do private purchasers from individual bondholders, and that's another way to gradually reduce your debt burden at a discounted price. For example, if normally your debts the face value is 100 and you buy it back at 50, you've just saved yourself $50 of debt obligations for the future. We also have in the bondholder situation the rogue bondholder, and we've developed a gimmick for dealing with that. And that gimmick is, let's see if we can pull it to the next slide. The use of an exchange offer coupled with consent solicitation. This is known as an exit consent. And as long as you have enough of the bondholders agreeing, and that usually would be, say, 2/3, to exchange their existing bonds for new bonds, which might have a lower yield, a longer maturity, that works even if you have rogue or bondholders not agreeing to that, because along with the exchange offer, you have an exit consent, and 2/3 of the bondholders vote in favor of stripping out a lot of the covenants that otherwise would be protecting the rogue bondholder that stayed, because the rogue bondholder still has its original bond with its original terms, but modified by this 2/3 exit consent, including the elimination of the ability to accelerate. So the rogue bondholder will continue to be able to get its interest paid on time at the higher rate, but it can't accelerate. So it's just sitting there, and it's still, the rogue holder is doing okay. I mean, it's at least he's not preventing a debtor from restructuring its debt. Sovereign debt. This talks about Argentina because that was the hot item in 2003. We'll flip to the next chart, and this is a description of what was called the sovereign debt restructuring mechanism. Now, you say, why is Qualley talking about this? Because it's kind of dead. The reason I'm talking about this is this idea was promoted by the IMF in 2002, 2003, and it was a way for dealing with a rogue, not lender or creditor, but a rogue debtor. And Argentina was the classic rogue debtor. How do you get a restructuring of sovereign debt in the context of sort of a well-organized, thoughtful mechanism? And that mechanism was the sovereign debt restructuring mechanism. Now, Ken Rogoff, about when he was the chief economist at the IMF, and he's now back at Harvard as a professor of economics, wrote a paper on where did this idea come from. And the reason he wrote the paper, I think, was because Jeff Sachs was taking credit for this idea. And we all know, and Nora confirmed it, Jeff Sachs takes credit for all the good ideas in the world. But in any event, in his paper, he says the gem or the germ of this idea came from a paper written by a law school student just like you from the University of Virginia. And that student was my student, and I planted the idea in this person. He wrote a terrific paper. I helped, nurture it. I got a little footnote at the bottom, but Rogoff didn't mention that in his paper. So this whole idea came from a law school class just like yours. So what's the message? The message is write a good paper. Work on making sure it's a paper that has an idea that you can really contribute to, an idea that is going to be novel and you can build on it, and you'll have a lot of fun writing your law school papers rather than considering it a terrible pain. Anyway, the sovereign debt restructuring mechanism follows a lot of the concepts of Chapter 11. It eliminates the problem of the rogue creditor. It stays creditor litigation, provides for priority financing, debtor in possession type financing. Nothing terribly brilliant other than the whole concept of could you use this in the context of sovereign debt restructuring. Okay, next slide. As I said, this idea doesn't have much life right now. It may come back if, as Bill was saying, we start worrying about sovereign debt problems again. So it's at least worth having out there on the radar screen. What was really interesting is who was the principal group, or what was the principal group that undermined this. The principal group was U.S. banks. And U.S. banks did not want to lose the ability, if they needed to, being a rogue lender. I think it was short-sighted on their part because most major institutions do not act in a rogue-like fashion. Okay, next slide. Instead, the banks proposed collective action clauses. What these are is instead of requiring unanimity in order to extend the maturity of a loan or to reduce the interest rate, what you needed to do is all you needed was 2/3 majority vote. And these collective action clauses have been gradually inserted in a number of sovereign debt instruments, particularly Mexico, Brazil. But the idea has not caught on too well. And in order for it to work, every credit agreement that a country has must have a CAC in it. Otherwise, those credit agreements that don't have it, in effect, have priority or seniority over those that do have it. Okay, next. Legal enforcement, bankruptcy, very quickly. Bankruptcy laws of Latin American countries have improved a lot. What this really means is that you have the ability to restructure the debt of a borrower much more successfully than used to be the case. Mexico and Brazil in particular have improved their bankruptcy laws. In the old days, a debtor would just look at its lenders and say, if you don't do what I want you to do, I'll file for bankruptcy. And they all knew that bankruptcy was the end. I mean, you could never work your way out of a bankruptcy in Mexico. Finally, I mentioned, next slide, I mentioned a little bit, next slide, I mentioned a little bit about equity. One way to deal with debt problems is through debt equity conversions. This came out of the lost decade of the 80s of Latin America. That concept will come back again today in dealing with the problems we have. The other good news is equity in the form of private equity firms is coming back into Latin America. Now, these are firms that don't rely on leverage. They've got cash. There are terrific opportunities today with cheap prices to buy good assets in Latin America. Part of it is because the companies can't borrow in the debt markets and they don't have the standing to borrow in the capital markets. That still requires pretty high credit standing. So that private equity will be an important player, but the volume of private equity is just not enough to make an enormous difference. Strategic equity investors also will be important in Latin America to the extent that they see the opportunities that are there. Finally, we'll see a return to highly secured credit transactions, future flow securitizations secured by export receivables, things like that. And but it will be a combination of all these things that will be required and then some in order to provide the financing that Latin America needs. So, in summing up, the global crisis today, I think, is enormously problematic, very severe. I think Latin America is going to do a bit better than maybe the United States if they can get some financing, particularly trade financing, back in place. I think there will be terribly difficult periods of complex restructurings, reschedulings. There will be some bankruptcies. The sovereign debtors are going to be under stress, and there's going to be a good opportunity for young people, such as yourselves, to be involved in a period where you will learn far more than you'd ever learn during good times, because in good times it's very easy to raise money, it's very easy to do all sorts of legal transactions. Bad times really put a test to you. Thanks very much.
Well, Andrew, it's been a long time since I got such a low score on questions, but I demand a rematch here or something like that. Those are good, provocative questions for us to think about, and thank you very much. Our third speaker on the panel is Ivan Deku, who at a young age has an extensive career in Latin American finance, being involved as a counselor to the Ministry of Finance ministries in Colombia, Ecuador, and Peru, and currently doing that through the Inter-American Development Bank Board, and before that, working closely with ministries of finance. So, Ivan, if you could, and glad to have you down here for us.
Thank you so much for this great opportunity of being here in Duke University. And let me just begin this presentation by defining myself as a development banker. Now, what's that? That's a great question, because somebody asked me one day, what's the difference between a commercial banker and a development banker? Well, the way I describe it is a commercial banker is the type of person who lends you an umbrella in a sunny day and claims it back when it starts raining. In the case of development banks and development bankers, we try to lend to countries when the days are rainy. So basically in this presentation, what I'm going to try to do is explain a little bit some of the ideas that have been expressed by Bill and also by Andrew, and try to focus in Latin America and the situation of SMEs in the region. And let me just begin by defining the issues that I want to cover. I want to talk about the road to crisis, the current situation in Latin America, and the challenges that SMEs have in the region. And let's just begin with this phrase by Professor Anthony Giddens, who really describes globalization as a situation in where the whole world is interconnected. So why is this important in the current situation? Because once upon a time, there was really a growing global economy. And as you can see here in this chart, you can see that the whole world economy had a long period of economic growth during the last 5 years. And what caused that? Definitely, the U.S. one was one of those engines. And other emerging economies, such as China, were other engines in the global economy. Now, the good thing, as you can see here in the chart, is that inflation, not only in the U.S. but in the whole world, started going down. So that helped Latin America. Why? Because in the region, after the lost decade that some of you talked about before, we saw a good decade of economic growth, and a good decade that countries used to have sound policy, macroeconomic policies, and inflation start coming down, as you can see here in the major 7 Latin American economies. Now, that also helped the region to increase exports and also to increase the current account by having surpluses of around 3% of regional GDP. And in terms of international reserves, the whole region accumulated more reserves than ever. So it was a region that was having sound macroeconomic environments. And the risks that were always seen in Latin America as very scary were coming to an end, apparently. We saw the fiscal balances coming from 3% deficits back in the early 2000s to a 1% surplus. We saw public debt levels coming down. And we saw, this is a very important graph, because one of the main risks that was always perceived in Latin America was that we were very dependent on dollar borrowings, on foreign currency borrowings. And we started seeing local capital markets becoming more active and countries borrowing more in local currencies. So we saw a good situation throughout the whole region. Now, this is very important as well, because during those years, a lot of tax revenues started increasing in the Latin American 7 major economies. You can see in the left side of this chart how primary spending as a percentage of tax collections becoming to increase. And that helped a lot to improve social expenditure throughout Latin America. Now, what happened is that our social expenditure in most of the countries of the region was very pro-cyclical, because most of the countries started to spending all the tax collection increases by huge percentages. In the case of Venezuela, and this is very important for you to know the risks that are coming ahead, out of $1 that came from tax revenues, Venezuela spent 90 cents on social expenditure. And you can see countries like Chile or Peru that only spend 25 cents of those revenues. So they saved for rainy days. And now these are the countries that are having more counter-cyclical policies and they have room of maneuver. Now, while those things happened in the region, in the US, a bubble was being built in the housing sector. And you see here the amounts of new houses and existing houses climbing, boosted by a situation where the Federal Reserve had low interest rates for 3 years in a row. So that helped subprime borrowers to invest in the housing sector very aggressively. Now, this is an important graph. Subprime borrowing in the US for housing purposes jumped from 1% of GDP to 5% of GDP in 4 years. And the percentage of subprime borrowers in housing mortgages origination jumped from 8.5 to 20% in the same period. And if you see here, 80% of that debt was being securitized. So this clearly shows you that we were really playing with fire at that time. But nobody thought that was going to generate into the type of chaos that we have today. Why? Because most of the credit ratings, the rating agencies, define that debt as sound. And most of that debt that was issued by special purpose vehicles were rated with investment grades. So one day, everything changed. And as interest rates started increasing, what you saw was that subprime mortgages delinquency rates started climbing, the same as foreclosures. And this turned into this. And I think this graph clearly shows what we're having in the global economy today. You see how the subprime comes into the world economy with a domino effect. Now, is that affecting Latin America? I think Andrew pointed very well that Latin America seems very sound today, but it's not time for cheering that much. Why? Commodity prices are coming down. And these figures are a little bit old because they're from December 2008. They have slightly improved in the last month, but they're still they have fallen with respect to the last 3 to 4 years. Now, credit spreads are also increasing in the whole emerging market environment. Why? Because people are worried about what's going to happen in the next 2 to 3 years. They don't know how sound are those fiscal policies that those countries are implemented, or for how long can they cover with countercyclical policies. Now, sovereign bonds and capital flows to the region are also dropping. At the same time, that spreads for specific countries in Latin America are starting to climb at rates that were seen a decade before, even in countries that have investment grade. Now, the stock markets are also being dramatically affected. So the question is, what's going to happen to the region with respect to the U.S. economy? The great number that you have to have in mind is that a decade ago, the U.S. had an internal savings rate with respect to GDP of around 6%. And by year 2008, it came to 0. So if the U.S. economy starts correcting to raise again the levels of internal savings, that means there's going to be a huge economic contraction in this country. And the best that could happen to the world economy is that it doesn't happen very fast. Because if it happens very fast, then there will be a contraction for countries that are heavily dependent on exports to the US. Now, SMEs in Latin America. SMEs are very important in the region because they represent almost 30% of employment. And they, although you see here in this small graph, they only represent 8% of the whole breakdown of business type. The micro entrepreneurs are so dependent on SMEs because they are providers to those companies. So if SMEs start having problems because they cannot access the credit or because they don't have an export destination, they were going to have a massive negative situation in Latin America. The big challenges ahead for SMEs can be described into two groups. One are structural problems that I define as access to finance, investment climate, and corporate governance and the business culture. And the second group are related to the current financial crisis. Now let's see why is this so important. Because this is a survey done by the IDB a couple of years ago, and it shows that almost 35% of small and medium-sized entrepreneurs believe that the most difficult hurdle they have to do business is access to credit. Why? Because bankers in the region are very conservative, and they really want to cover themselves with respect to guarantees to issue loans. And most of these entrepreneurs don't have the assets to guarantee the type of long-term financing they need to increase labor force or new technologies or expansion. Now, in terms of investment climate, those companies want to have investors from other places in the world. They want to have venture capitals. They want to have private equity investors. They want to have even individuals that participate in their companies. But as a region, we're perceived as a region with a lot of red tape and with a lot of legality and in terms of procedures and the amount of time it takes to enforce a contract. It's really significant with respect to other regions in terms of the time it takes to enforce the contract. On average, it takes about a year to enforce a contract if you have a good position in Latin America. So that's something that needs to be solved. Now, in terms of corporate governance, let me show you two examples. This is Brazil. Investors from abroad that want to put their money in SMEs in Latin America are always concerned that the major shareholders, either the major or the three major shareholders, have more than 60 to 80% of the shares of a company. And they don't want to lose control. So that's why always foreign investors want to have control of the companies, and they want to exercise anti-dilution clauses or try to acquire the 100% of the company's shares. And local entrepreneurs don't want that to happen. So that's a major hurdle that needs to be solved. In case of Argentina, the existence of audit committees that is believed as a world standard that should be applied to all SMEs it has a grave situation because almost 50% of SMEs in Argentina, this is based on a Corn Ferry international survey, only 50% of the companies that were surveyed have an audit committee. The amount of board meetings still is very much below the world high standards average. And in terms of the impact that they could suffer from the global recession effects, this is very important. Because in an environment where you don't have the confidence on your corporate governance and where you don't have the trust on the soundness of the legal system, in a situation where you have less exports, decreasing fiscal revenues, that means that countries need to maybe increase taxes in the short to mid-term. And you have limited countercyclical capacity to have stimulus plans for small and business entrepreneurs. And you don't have a capacity to access the capital markets to raise funds either by IPOs. And this is just an example. Last year, we only had 67 IPOs in Latin America. 90% of those IPOs were done in Brazil. So most of the countries don't have an IPO structure for companies to raise money in local capital markets. Where you have a reduction in foreign direct investment and a drop in mergers and acquisitions, as well as falling commodity prices, then SMEs could be the biggest victim in the region. Now, this is another element that I wanted to touch. What happens if we have an L type of recession in the US, if it's pretty long? What you're seeing here in this graph are some analysis that were done by the IDB that showed that in 1980s, when we had the debt crisis, it took 4 years to Latin America to recover from the crisis. And after the Russian crisis, it took 2 years for the region to recover. Now, if we have an L type of recession in the US, it would take very long because we're heavily dependent on exports to those countries, to the US. Now, the other major risk that we have is what happens if big economies that are facing recession start implementing protectionist measures, such as trade restrictions or non-export tax barriers for exports from Latin American countries or for other emerging markets. And what happens if there are tax incentives for local companies to produce? Let's say Buy American in the case of what was discussed in the stimulus plan that was so controversial last week. Those are type of measures that could really produce a negative impact in Latin America. Now, I don't want to be pessimistic, although somebody says that there's nothing more interesting than asking money from a pessimist banker because he doesn't spend the money back. What I really want to show here is that Latin American SMEs could be a huge victim of this crisis, either by currency depreciations, by weakening of credit lines, or by an industrial production contraction. Now, the survival would depend on the type of recession that we have in the US, on if we can develop a private equity, a venture capital, or a capital markets that is more linked to raising resources and financial resources for those companies, if we introduce the right regulatory reforms and the strengthening of the credit lines. Now, my positive message is you still have an opportunity because you have SMEs today that are resilient, that have good capital base, that have good internal market conditions. You have trade agreements in CAFTA, the Dominican Republic, and Peru. You have growing industries in Latin America, which are not basically linked to that much to the cyclicality of the economy. And you have more digitally connected societies. And it will be a buyer's market. 2 years from now, a lot of SMEs would be bought very cheap in Latin America. And if you have SMEs with a good capital base, with good technology, and you have a trade agreement with the US, that would be an opportunity that you should focus in. And basically, sorry if I went too fast, but those were the issues that I wanted to cover today. Thank you.
Well, Well, I want to thank Bill and Andrew and Ivan for great presentations here. We need to keep the train on schedule here, I believe, and so we're at the appointed hour for closing here. So maybe we'll have a chance in the hallways or otherwise to ask our panelists questions. But let's give them another round of applause. They did a great job. Thank you.
Good afternoon. I would like, just before going to our coffee break, I would like to thank our panelists and for their very interesting and enlightening presentations, and also to our moderator, Professor Cox. We will give them a small press gift in the name of our associations. So thank you very much.
And I have the privilege of moderating this panel here today. So thanks again for being here. The topic of the panel is private equity and venture capital. So I always think that the best way to predict future success is to study past performance. So I'm happy to be here for this panel because we're going to be able to see the practical application of some of the principles that you probably have seen during this symposium. So having said that, let me introduce our first panelist. His name is Juan Pablo Capello, and he's currently the principal shareholder at Greenberg Traurig, the fifth largest law firm in the United States. He advises large funds and multinationals on their investments in Latin America, and formerly he was one of the 5 partners at Paragon. Paragon was a .com that was sold 3 ways before the NASDAQ high in March 2001 for more than $250 million to Banco Santander. Many commentators consider Paragon the most successful private equity ever for Latin American exit for a Latin American company. And Paragon was a financial institution with brokerage and banking operations in 6 different countries throughout Latin America, as well as in Spain and in the United States. While at Paragon, Mr. Capello was responsible for all legal and compliance matters. So I would like to allow Juan to present at this time.
Okay, great. Well, thanks a lot. Thanks for coming here late on a Friday. I'd like to thank Fuqua and the law school for the invitation. I imagine there's at least 2 reasons I'm probably here today. One, I'm sure Carlos Slim wasn't available, and he probably isn't an alumni the way I am. I actually went to Duke College, though. I found out that probably had nothing to do with my being invited. Or maybe it does, because I think I still owe some money on my Duke flexible spending. So maybe they thought this was a good way to shake it free. I guess I should start, as I always start when I'm asked to talk about these kinds of things, that what I'm going to say doesn't at all reflect the opinions of my law firm. Actually, I'm sure they're generally horrified by what I say in public. So just keep that in mind. I think, one success to good presentation is you have to manage expectations and keep them very low, which, being a lawyer, that should be pretty easy because you guys should have low expectations already. I think that, Woody Allen said that 80% of success is showing up, and I think, the other 20% is keeping expectations in check. I think we sold our company for $750 million. And it's sort of interesting because I feel a lot of times, to be honest, that in these presentations, most of the panelists are invited because of all their success and success over decades. And in fact, when I look back on my 20 plus years practicing in Latin America, I'm originally from Chile, I sort of feel that, it's been a series of failures, but I sort of feel like in all these panels, you need somebody, at least one panelist, to sort of get up and give the talk about how, through failure, you actually learn something. And that's usually what I feel sort of my role is. At least when I used to study here, I was always somebody who would rely heavily on cliff notes or executive summaries, et cetera. So I'll just give you guys sort of the bullet of my presentation, and then I'll sort of get into it. I think we're talking about, doing business in Latin America, and the reality is, for me, doing business in Latin America, unfortunately, to this day, Latin America is still a trade. That if you want to be successful in business, you can't just be sort of on autopilot and think you made a choice and not pay attention to that choice for the next 20 years and think you're going to be successful. I think the reality in Latin America, and unfortunately I think in the United States more recently, which I think is too bad, in the United States people sort of have this added, I think, belief, and I definitely suffered from it, that you could put your money in the bank or the stock market and not look at it for 20 years and all things would be very happy at your retirement. I think one of the things and one of the reasons that this crisis, very recent crisis in the international markets, has affected people so much in the United States is precisely because the reality is for 20, 30, 40, 50 years in the United States, if you've pretty much just been on autopilot, you've been okay. I think for us who've done business and grown up in Latin America, our view of the world is very different. I was talking to some of you guys from Argentina at the coffee break, and people in Argentina, obviously, you guys were most of you were somewhat young, but in 2001, 2002, with the big crisis, you guys have been through something incredibly difficult and gotten out the other end. And I think here in the United States, and at least when I hear some of the presentations I heard earlier today, having not been through that experience, obviously, you find it unsettling in any event, but particularly because you haven't been through it. So anyway, I was asked back about 3 years ago to give a presentation, maybe 4 years ago in Bogota, just on this topic, sort of private equity, what did I learn at Patagon? And I had a presentation with lots of charts, et cetera, and I realized that really wasn't very helpful because I never follow those kinds of presentations anyhow. And I sort of looked out at the room, and I might have had, sort of a Jerry Maguire kind of moment where I just sort of felt like I should speak the truth and probably end up looking ridiculous by doing so. But also, at the time, we had sold our company to Banco Santander, and I really was hoping to get fired. We'd cashed out, and I had a contract, and I just sort of felt like it would be nice if I could just, have them push me out. And what better way to do that than say some provocative things at a conference? And what I said, I think, is in some ways apropos to what's happening today. This was a conference with a lot of companies and smaller companies that were growing quickly, were going to need capital. And I asked how many of those companies were hoping to, raise money or get debt financing in the next couple years, and almost everyone raised their hand. And I said, look, here's my advice. A lot of you, when you guys are going to be discovered by the international banks, Colombia's really been off the radar screen. It's getting increasingly on the radar screen. And you're going to have these commercial bankers showing up, increasingly offering you money. And my advice is you should take the money. And don't worry so much about the interest rate, whether you're paying, LIBOR plus 200 basis points or LIBOR plus 300 basis points. Of course, you want to negotiate that a little bit, or the bankers get nervous, but I wouldn't really worry about that. What I'd try to do is, stretch out the maturity, try to pay as much as you can on the back end and early on in terms of the amortization, and take half the money and put it under the mattress or put it in a Swiss bank account, and take the other half of the money and do whatever you want with it. If you want to go to Las Vegas, go to Las Vegas. If you want to invest it in your company, invest it in your company. If you want to spend it the way I know you probably want to on women and airplanes, do that. Because it really won't matter, because really only one of two things is going to happen. One, los vientos van a soplar a tu favor. The wind is going to be at your back. The economy in Colombia will just continue to grow. It's going to be in one of its cycles where it's up, and really, almost regardless of what you do, your company is going to be successful, and you're going to be able to pay that money back. Or the world's going to implode, or Colombia is going to implode. It's going to come down a cycle. The FARC's going to get strong again. And there, what you're going to find is that regardless of how good you ran your business, it's going to be almost impossible to pay that money back. And then guess what? You have those 50% of your money. And when you show up to the bankers at that point and offer them to buy back your debt on 50 cents on the dollar, they're going to be thrilled. Well, as you can imagine, since Santander was my employer, that didn't go over that great. And more importantly, my father was actually in the audience. And he's a very traditional sort of Chilean guy. Like he thought, he still to this day is sort of disappointed that I don't have a job where you have a lot of keys. Like he sort of felt that the more keys you had with you, the more important you were. And so when he heard that, I mean, that was terrible. And he asked me, hey, son, why did you become so cynical? What's happened to you since you moved to the United States? And really what had happened to me was twofold. One, for the first 10 years of my career, I started in Chile and then I worked at a big law firm in New York. And I was involved in primarily involved in helping Latin American companies raise capital. Initially, we're primarily helping companies list their shares, Latin companies list their shares on the New York Stock Exchange through ADRs and a lot of international bond offerings and the like. And I was involved in about $5 billion worth of issuances or more. And I realized that at the end of 7 or 8 years of doing this, because of the cycles, most of the investors had lost most of their money. I mean, the reality was that, rather than creating a lot of value, the value was created for the bankers and the lawyers. But the investors who just bought and held didn't do very well. Of course, investors who traded did well because there were moments to sell and moments to buy. But if you just held, it really didn't work out very well. And then it was the time of the internet boom, and this will get to sort of Patagon and I think what I'm supposed to talk about. And I was sort of receptive to the idea of doing something. And there was the founder of Patagon was a guy named Wenceslao Casares, very well-known, emblematic serial entrepreneur in Latin America. And when I sat down with him and the guy who was sort of running the company, and they were inviting me to be a partner, I was asking him a lot of old-fashioned questions, like, how are we going to make money? When's this company going to break even? And I remember this, the other guy, Daniel Canel, said to me, look, I'm going to answer all those questions for you, but you need to keep in mind that part of this is like Hollywood, like making a movie. You need a good story, you need good production, all that we're going to have. But you need magic, and you need the right elements to make this work. And I remember this guy, Daniel Canel, thought very highly of himself. And he said, I'm like Harrison Ford. He was an older ex-trader from Wall Street. He said, I'm like Harrison Ford. This is my first time I'm directing, and, that's going to be amazing. Wences, he's like Tom Cruise. And, the private equity people are going to eat him up. We had this round A investor sort of lurking, Chase Capital Partners. A woman there was Susan Siegel, who was very well known. I think he described her as Glenn Close, which I'm not sure she would have appreciated. But it was very sort of startling to me that having been on Wall Street for like 10 years, and it was almost like somebody opened a door, and I just realized, wow, there's this whole other way of looking at the world. And you know what? Maybe that very analytical, technical way I used to look at things, fighting about little covenants and everything, while important, isn't nearly as important as this conversation I'm having now. I mean, I'd been doing that for 10 years, so I felt pretty dumb for not ever focusing on that. And anyway, make a long story short, we ended up 2.5 years later selling the company to Banco Santander for about for $750 million. In the interim, we bought 6 companies. We raised about $150 million in various rounds of financing. And we often get asked, and somebody asked me in the hall, how did you guys do it? And the reality is, this company was ultimately run by this guy, Daniel Canel, who had been a trader on Wall Street. And he viewed the company as a trade, and he realized that in Latin America, unfortunately, it gives me no pride in saying it, but it's the reality of things, Latin America continues to be a trade. There's times to buy and times to sell. One of the companies that we had the same investors, and we were sort of our peer, Star Media, went public. And I remember that when we sold, Star Media was going public, and the founder of Star Media, Fernando Espuelas, told us that we were making a huge mistake, that we were leaving tons of money on the table, that made no sense. And our view was, no, in Latin America it's a trade. You don't want to be a public company and not be able to sell your stock for forever, basically, even after the 6-month lockup period. What you want to do is get your trade. Now's the time to sell, and when things go down, that'll be the time to buy. And it was interesting because after we sold the company and got out of our commitments to Santander, actually the guy Wences went on a sailboat, and he went on a sailboat because he sort of felt that the cycle in Latin America, we sold 3 days before the NASDAQ high. Things went down, but we were still tied up with Santander. And then about 2 years later, when we got out from our commitments to Santander, he sort of felt that the cycle was beginning to be in Latin America, that you'd rather be a buyer than a seller. And he said, well, that's not a good time to start a company. And he got on a sailboat, and he came back about a year ago, sort of feeling that things had gotten overheated enough in Latin America that they were going to crash, and that it was going to be a time to maybe do 2 things. One, start a business, because you want to start a business when things are bad, so that when things are good, your business is mature enough so you can sell it. And then also with the opportunity, to buy businesses. And so with that, I'll just, try to wrap this up before I bore you guys to tears. Just a couple lessons, maybe a little different than what you've been hearing. I get a lot of resumes all the time, virtually every day, from people who want a job. And I think, I don't know, a year or 2 years ago, it was probably a good time to have a job at a law firm like ours, or at a consulting firm, et cetera. Now I really think that it's a terrible time to have a job. I'm not saying there aren't jobs to be had. There are jobs to be had. But if any of you were my brothers or brothers-in-laws, I wouldn't recommend you to have to look for a job now. I think now is a great time to start a company, or to get involved with a company that's reaching critical mass, and it's beginning to think about expanding internationally. There's organizations like Endeavor, which promotes entrepreneurship in Latin America, that has, literally, I think over the last 10 years, have selected about 400 companies, Patagon, UP, Star Media, Mercado Libre, that just went public, are all companies that have been promoted and supported by Endeavor. Well, they at any given time probably have 30, 40, 50 companies that I think are sort of at inflection points where those companies are really growing, looking for international expansion. And I think it's especially now, it's a much better moment to get involved with one of those companies. Valuations are low. You can get in there and not just get paid a salary. And I really think those are companies, when we come out the other side of this crisis, whether it's in 2 years, 3 years, or 4 years, you could be very well positioned. And that's a little bit, the lessons for today. That I think, now if you have money, which maybe not everyone here does, obviously it's a good time to buy. If you're at a company, you're just in survival mode. But I don't think that's bad, because my view is, in Latin America, I have to say, I don't quite understand all these presentations about why the crisis is happening. I think all you have to do is really understand that the crisis has happened. that it's unlikely, if you believe in that the world isn't going to end, that this crisis is going to last forever. And all you have to do is just be positioned, knowing that in Latin America, as far as I know, the business cycle is just going to keep going in a very sort of obvious way, up and down. And it's from my perspective, it's fairly easy. I think much easier than in other markets to recognize those cycles and position yourself to take advantage of them. So that's sort of the lessons for today. Interestingly, about that Bogota conference where I tried to get fired by Banco Santander, it turned out there was actually a lawyer there from Citibank who's become actually one of my principal clients in the region. And he actually spoke after the conference to the head of the international practice and the CEO of the law firm I'm at today. And he actually said, hey, there was this crazy guy who's some private equity guy with this company, Patagon. He got up in this conference, and you're not going to believe what he said. And so he sort of told the story. And he said, I was thinking about it, and I was thinking, you lawyers never give me that kind of, practical advice. You guys are always, so focused on the details. It would be really good if you guys had somebody like him. And so, a year later, I was actually hired by my law firm. I think, from my perspective, the point there is, in Latin America, there's also a lot of, conventional wisdom out there. And, I think it's, well-intentioned a lot of the times. And my sense is that, a lot of what we need to do as people interested in the region is really challenge that conventional wisdom. You have the conventional wisdom that, Venezuela's a disaster, not a place to do business. Well, the reality is there's been Venezuela has huge challenges, but companies that haven't been in the miras, in the political targets, there's been a huge consumer boom in Venezuela the last 5, 6, 7 years. Most of our clients have figured out ways to get money out, have made money hand over fist in that market. Another piece of conventional wisdom going around is that Brazil's made structural institutional changes that aren't reversible. And I tend to disagree with that. And my view is that Brazil still has a long way to go. You have things like Mexico, where part of the world seems to believe that Mexico is investment grade, and other people seem to believe Mexico is a failed state. I think people really from the region have a lot to say, and they shouldn't be shy about being honest with their clients, if you do have clients or if you're in businesses, to look at those issues. So anyway, that's pretty much what I wanted to say. I'm happy to answer any questions you guys might have after the next presentation.
Thank you very much, Juan. Let me now give you the introduction for our next panelist. His name is Miguel Noyola. He's a partner of Baker & McKenzie, where he heads the Latin American practice in the Chicago office. After earning his Mexican law degree from the University of La Salle in Mexico City in 1982, he earned a Master of Laws in 1984 and JD in 1986 from Southern Methodist University. Mr. Noyola is licensed to practice law in Mexico and Illinois. Mr. Noyola works primarily in the area of foreign investments, international joint ventures, and mergers and acquisitions in Latin America. For many years, he has advised and assisted multinational companies in executing cross-border transactions and negotiating and implementing joint ventures. Mr. Noyola is an adjunct professor at Georgetown University Law Center. Thank you for being here.
Sebastian, and thank you so much to the business school and to the law school for inviting me to this panel discussion. I don't know whether I'll be able to replicate the story of my colleague here in terms of a movie set and movie actors. I'll perhaps be a little bit more granular in terms of some legal concepts associated with doing business in Latin America in the context of joint ventures. It's also a pleasure to be here and seeing LLM students, because I remember not too long ago, although perhaps most of you who were in the LLM student had not been born there, then in '83 coming for a 1-year program. I was one of those diaspora students that escaped the devaluation and a nationalization in 1982 in Mexico, followed by exchange controls and other exciting times at the time. So a 1-year program turned into a JD degree, followed by an associateship and then a partnership at an international law firm. But the theme that was selected for today's discussion is one that is dear to my heart because it presents very interesting issues. Joint ventures are both fascinating as well as controversial from a legal perspective. Fascinating perhaps because they present very interesting challenges and complex issues associated with negotiating or implementing a joint venture. But the good news is that if properly structured, joint venture perhaps are quite rewarding in seeing two independent parties coming together and making the best of a joint opportunity. It's a controversial issue because, as it's been discussed, there are ups and downs, and if one were to be merely statistical, one would realize that the success probability of a joint venture is rather low. I have, when I speak with colleagues and businessmen and economists about the subject, I have my views as to how they measure success. But some say that the probability of a long-term joint venture is on the low side. But from a legal perspective, what I find interesting is that joint ventures are not business arrangement or a commercial opportunity that is framed by legal concepts. And I know that when I speak with my colleagues in the region, my legal colleagues in the region, they sometimes get bent a little bit out of shape because those of us who had the opportunity to be raised in a civil law system were trained to believe that if it's not in a code or in a regulation, it can't exist. So you go to any commercial code or civil code or administrative regulation and you look the concept of joint venture, you won't find it. So for a while, many legal scholars and many lawyers got a little bit discombobulated when they thought of the US or Anglo term business-driven associated with a joint venture. But I think that in the last decade or so, there's been a greater understanding that the concept, albeit not legal, it has a lot of very interesting legal issues that need to be addressed in terms of a commercial or business arrangement that simply means that two or more independent parties come together to carry out a common enterprise with the idea of sharing an economic profit or an economic goal. So if I just move on to this slide, you will see that I list out a couple items for thought. First, that the definition of joint venture is very broad. From not too complicated contractual arrangements to sophisticated and complicated equity-driven business structure. So there's a great opportunity to develop joint venture arrangements in that very broad definition of what the term means. If I had to classify it into two buckets, I would say from a legal perspective, there are two types of joint ventures: the contractual joint ventures and those that are equity owned, or those that we refer to as corporate joint ventures. Now, to speak just briefly on each of these two types of joint ventures, beginning with those that are contractual. Perhaps in the 70s and 80s, when Latin America was essentially a closed border region, import substitution models, where there was tremendous restrictions on how you could trade with the region or sell into the region or transfer any kind of technology into the region, contractual arrangements were difficult to implement. Because if you wanted to sell a bicycle manufactured in Wisconsin into the Mexican market or the Brazilian market, the bureaucracy associated with getting an import permit was so great that you just forgot about that opportunity unless you were ready to take a much more significant step in adopting a minority position in an equity joint venture, but that was a leap of faith. Similarly, if you wanted to license technology to manufacture that same bike. You know, the agency in Peru or in Brazil, in Mexico, and Argentina would make it so difficult for you to protect that technology or to receive back from the licensee royalties that in those days, it was difficult to enter into contractual JVs. Then, as you might all know, you know, the pre-NAFTA, the NAFTA negotiation comes, perhaps led by Mexico and Chile. There's a new policy towards foreign investment, to trade flows, etc. And countries begin replacing their closed border mindset to one of free trade based on fair rules, mainly guided by WTO principles, etc. And it is in that context that you begin to see greater negotiation and execution of contractual JVs. You might have a plant in North Carolina that manufactures furniture. They have an excess inventory or idle capacity. They had the opportunity to reach out to a partner in Brazil, in Mexico, Argentina, with whom they could negotiate some kind of commercial distribution agreement. That's a commercial JV. Similarly, you might have a home appliance company in Iowa that manufactures X type of refrigerators, where they might not have the excess capacity or the idle capacity of the excess inventory, but they have valuable technology they would want to license to someone in Mexico City or in Sao Paulo, with the idea that by sharing that technology, they could generate a relatively risk-free stream of revenue in the form of royalty payments coming back to the licensor. Some interesting issues associated with negotiating the contractual type of JV that we've seen as lawyers have to do with definitional terms. You know, you have that now let me use the example of a food and beverage company that wants to expand into the Latin American market. They're very clear as to what division of product line they want to license or share in marketing in the region, but the local party, the Brazilian investor or the Mexican investor, are interested in the full product line. So we have seen a lot of interesting discussions associated whether a food and beverage company should just limit to that to the Pepsi drink or should expand it to the Frito-Lay salted snacks. But as lawyers and as businessmen, we need to be very careful exactly as to what the market we're proposing to expand in the region, and that's part of the negotiating the agreement. Same with territory. I don't know, there must be 100 different definitions that I've seen businessmen use for Latin America. For some, Mexico is in North America. For others, it's in Central America. For some, it's in West Africa. Same with regional, Central America has its own dynamics. So whenever you enter into contractual JV, you need to be careful as to how you define exactly the scope of territorial grant that your client, in particular if you're representing the international player, you want to describe in a contractual arrangement. But moving on to the other bucket of JV arrangements, perhaps the one that's received the greatest publicity, and perhaps the kind of JV that has the highest degree of failure rate is those that have to do with equity ownership in a JV vehicle in the form of some kind of incorporated entity through which the partners conduct their business. And these are interesting and challenging joint ventures to put together. Again, because they're complex, they sometimes deal with interesting international issues, linking together legal systems that are not always in sync. But at the same time, that properly structured can result in appropriate business models. We all remember when Walmart first expanded globally, their first international step was to enter into a JV with a large Mexican retailer and warehouse club operator. And that joint venture then went from a minority position to majority position to an entire buyout. So that's an example of an interesting corporate joint venture that was successful. Similarly, I think in the beer distribution business, we saw how a commercial JV then turned into an equity JV in the example of Anheuser-Busch and Modelo, and that's one that has had its interesting ups and downs in terms of the dynamics of corporate governance at the level of the JV and the relationships between the partners. And now that the Belgian company bought Anheuser-Busch, I wonder how the Mexicans feel negotiating now in French as opposed to in English. But that's an interesting example of a corporate JV. But all in all, in my view, to attempt to mitigate the risk of failure associated with a JV, it is very important that from the outset, the parties set the roadmap of the most important elements that compose that JV, so that they can truly and frontally address the opportunity and the challenge associated with those issues, as well as to testing whether they really have a meeting of the minds in terms of their business opportunity. As lawyers, I'd like to believe that one of the roadmaps that can be a very nice outline for testing the validity and the efficacy of the joint venture is the negotiation of an appropriate joint venture agreement, the JVA, that not only has all the legalese and the appropriate legal terms in it, but that it serves as a tool for testing the business propositions associated with a JV. And I'd like just take a couple minutes as to which are some of those business issues that I think need to be addressed from the get-go. The parties need to decide what the purpose of the JV will be. Will it be one associated with a special project, with a marketing and distribution arrangement, with manufacturing, and whether that proposition is regulated in some form in the destination country that might impose some regulatory limit to foreign investment. We still, notwithstanding the opening of markets and NAFTA and trade agreements and investment protection arrangements and CAFTA, et cetera, each country reserves a menu of limited economic activities. In some countries, like Mexico, oil and gas is taboo. In others, it's media. In others, has to do with making special arrangements with unions and et cetera. So the first test in your negotiation has to be whether we agree that the joint venture will engage in X activity that allows for the parties to determine on an arm's length basis what's going to be the equity split, or is it subject to some kind of concession where the international partner will be limited to 30%, 40%, 49%, restricting it from conducting business as a wholly owned company. So that's one issue that I think it's interesting in spelling out in terms of the JV. Next issue, what vehicle are we going to use? And interestingly enough, for most Latin American investors, it's a pretty straightforward answers. You know, in Mexico, we normally use the SA, and if it's in Brazil, it's the Limitada. Seldom do they use the branch alternative. But at the end of the day, if you're representing a U.S. company, this becomes a U.S. planning decision. Because for the IRS, there are certain types of international entities that qualify for the so-called pass-through or partnership treatment of the investment, so that current losses can be credited or recognized directly on the U.S. tax return, whereas if you use an entity that does not qualify for that, they get locked at the local level. And normally speaking, the general rule is that an SA, a Sociedad Anónima, regardless of where you incorporate, cannot benefit from that treatment. So for many reasons driven by tax implications, most JVs are negotiated in the form of an SRL. So, you know, similarly, your JV needs to address the issue of capital structure. That can be driven by regulatory limitation, as I mentioned, but most economic activities now in the region are open to wholly owned investment, so that allows for a negotiation on the equity split. You know, it could be a 50-50, or you can have a majority and minority owner. Associated with that, you need to spell out, the ability or flexibility an owner has to exit or to move its equity investment to a third party. If you are not in the trading business, but more in the long-term investment, this might be a very significant issue, because if you have taken time to select your joint venture partner, the last thing you want is for your joint venture partner to move into a different business or to sell out, and you end up with someone that might not be of the kind of partner that you would otherwise have. It also raises very interesting issues associated with selling to competitors. And we've seen the situation that, notwithstanding clear covenants not to do so, because of the restrictive nature of some legal systems in the region, there is no absolute prohibition against selling the share of an SA, for example. So if you were comfortable in having a legal provision saying that, and later realized that because you did not put the appropriate stock transfer provision in your agreement, your partner then sold to a person that competes with you, it could be a very sensitive issue. And those stock transfer arrangements sometimes are in the form of rights of refusal, transfer only with majority consent, etc. Corporate governance, another very interesting area that needs to be spelled out in terms of lines of authority. Who, from both a corporate governance perspective and one that associates with resolving issues either at the board or at the shareholder level, but also on the operational side. Who will be the party that, when there is a discussion about adopting a resolution, will have a say as to how to move forward? And whether there will be certain fundamental matters that, notwithstanding the majority view, will be subject to the veto or to the rejection of the proposal by the minority partner. And these are items that you would spell out to protect the minority owner against unwarranted actions that would be contrary to the spirit of the JV. Say, enter into an agreement by the JV company with a related company of the majority partner, or enter into some kind of major project or major contract that's outside of the scope of the business. So you can actually list out those areas that, from a business perspective, would be so key that, notwithstanding deadlocking the company, it's preferable to prefer the minority shareholder than going forward with a minority resolution that would take the business in that direction. And if there's deadlock, you should talk about how you would resolve it to avoid permanent paralysis of a company. And there are many ways that lawyers can draft associated with buy-sells and things of the like. Lastly, from a legal perspective, you must remember that you are in two legal contexts. One driven by the nationality and the legal system of one investor, and the other driven by the nationality and legal system of the other investor. And fatal mistakes are made when you rely the underpinning of your documentation just relies on one legal system. So if you negotiate a very elaborate JVA under New York law with all kinds of bells and whistles applicable under a U.S. law, common law system, and do not reflect that to the extent possible on the local application of that document with respect to the operation of a company in Mexico and Brazil, you're making a big mistake. Because at the end of the day, for local law, notwithstanding your choice in a commercial or private agreement, that local company will be governed by the local law that applies to corporate governance. So your U.S. or international agreement needs to be drafted in a way where the local bylaws of the local company will be implemented. And that needs to be memorialized in most countries in a pretty formal notarial document in the local language, either Spanish or Portuguese. And you need to be aware, to the extent possible, that if there's any discrepancy between documents, and it has to do with the local operation and corporate governance of that entity, it'll be governed most likely, if taken to court locally, by the local law. So if you're representing that international client, you need to make them aware of that situation so that they feel comfortable understanding and operating under the law and business culture of that second country in Latin America. And just basically to conclude, this is a question that I've been asked by many colleagues and clients that are interested in doing business in Latin America or that already invested in Latin America in terms of trends. We think that joint ventures will probably go up because right now we're seeing a shift from very open trade and investment-minded views and policy to more restrictive ones. Perhaps, Venezuela is in one extreme, but you now are seeing movement in Brazil and Argentina that are abandoning what they did maybe 10 years ago with Menem and shifting more towards the middle. Even Mexico, notwithstanding that we go out and say that we're the country that has been more liberal in negotiating agreements and protecting investment, well, we have this big white elephant in the middle of the room called Pemex that is impossible to break up and to allow direct investment by foreign nationals in that sector, or even Mexican nationals in the sector. So it is those regulated activities that will lend themselves to joint venture opportunities. Also, we're going to, if you see the budgets of most Latin American countries, as we are now experiencing in the US, huge budget dollars associated to infrastructure projects. Those infrastructure projects normally require some kind of combination of aptitudes and skills with foreign investment, with local investment, and that is, sort of the context ripe for a kind of a joint venture arrangement. So we think that we're going to be seeing more JVs on that front. The other big trend, corporate compliance, and Sebastian might be able to speak more on this front, but it is very clear that the U.S. has sent a signal, and we just very recently had the Siemens case, about the extraterritorial application of U.S. law when it comes to corporate governance and corporate conduct. And that is, you see it in FCPA issues and SOX issues. So to the extent that U.S. companies or European companies enter into a JV agreement and enter into JV business arrangements in the region, the U.S. investor, as well as the local investor, will be tested to the U.S. standard of corporate conduct. And if a U.S. investor or a U.S. person enters into a deal that is inconsistent with U.S. law on these fronts, you can rest assured that the DOJ will be quite interested in interviewing your directors, interviewing your officers, and connecting with the local public prosecutor to exchange notes, and to enter into some kind of agreement that at the end of the day would be very painful in terms of penalties and fines and the threat of criminal prosecution. So that is an area that, at least from a due diligence perspective, both on the legal as well on the financial and business side, will gain importance. Covenants or reps and warranties that perhaps were a line or two in the past in terms of compliance with all laws will become a much more robust provision that will require the appropriate and reasonable due diligence, so that if there's ever an illegal conduct, there'll be a defense or an explanation to a regulatory body, whether in the US or Europe, that will explain that you did your best to control the conduct of your JV arrangement. In particular, if you have a majority position on that investment. With that, I conclude my comments. I'll be happy to join the panel for taking questions from the floor. As you want to proceed, Sebastian.
Thank you so much, Miguel. And I'd like to open now for questions. We have a few minutes and I can start with one that I have for Juan Pablo, and then I would like to be joined by the audience in asking a few more questions here. But just like in Latin America, just like in the United States and Latin America, to incorporate a company, you have to fulfill certain requirements, and you have to register with a state agency, and there are a different set of requirements that they're not very different than the requirements that you have to comply here in the United States, but perhaps in practice there are some differences. So I'd like to ask Juan Pablo, what are the biggest challenge in setting up Patagon that he recalls?
Well, the reality is the biggest challenge was at the time that there were, in Latin America, there were virtually no role models. So to get anyone to believe that a company like ours could be successful, unfortunately, the reality is we had to come to the United States to look for capital because we couldn't find anyone really willing to invest in us locally. To give you an idea, our angel investor, who in theory put up $300,000, but in fact he put up maybe $30,000 and lent us some assets. So he got back about $100 million on his investment. No one else, we knocked on 500 doors and, basically realized that our shoes were wearing out. And when we went to New York and Silicon Valley, we probably, we didn't knock on doors, we had introductions, but probably, out of our first 10 meetings, we had 3 or 4 very interested investors who were willing to accompany us the whole way. So I'd say, the biggest thing is the lack of role models, and that's where, the sort of culture. It's interesting because I think in Latin America there's a real culture of entrepreneurship in terms of the informal sector, and people really know how to survive, and a lot of people live in this informal sector. On the other hand, more entrepreneurial kinds of traditional investments in Latin America, there weren't at the time, and there still haven't been enough successful ventures. So that was really the main challenge, more than any sort of regulatory or political hurdle, was just lack of role models.
That's interesting. Any other question over there?
I also have a question for Juan Pablo. I would like to see, you mentioned that there are some buy opportunities. So which do you think that will be those opportunities from now onwards, and how do you see them happening?
Well, in the larger, I think it's pretty obvious. You have a lot of, we heard some about private equity funds, which I agree are going to step into this weakness. You have a lot of hedge funds, private equity funds, other funds that, let's just say, might have been a $10 billion fund, and it had a 3% allocation or 5% allocation to Latin America. And it hired one person to be sort of their Latin American analyst. They probably hired 2 people for Asia and had an 8% allocation there. And the fund that's based in Seattle, Washington, made $300 or $400 million worth of investments in Latin America 2 or 3 or 4 years ago. It owns 15% of a copper company in Chile, 20% of an ethanol plant somewhere in Brazil where management, where they've never been. And now that fund is under incredible pressure from its investors to return money. It's gated. It's not allowing their investors to get their money, and it's looking at its portfolio and it's deciding, what should we sell? Well, what they're dumping, the reality is, a lot of their real non-core investments. And given that the guy who made the investments 2-3 years ago is long gone, that's the first thing they're going to sell. And forget 50 cents on the dollar. A lot of those investments are pennies on the dollar. So that's the kind of obvious opportunity that I'm talking about. We're just, and we've been through it. In 2001, for instance, Goldman Sachs had a fund that was heavily invested in Argentina and Chile. Given that there was almost no buyers in Argentina for that fund's assets, it dumped its primarily forestry assets in Chile to a very large group. Everyone knew this group was buying these assets for a song, and those assets now, even today, are worth 5-10 times what they paid. So that's where I say I just think you can if you think about things strategically, and you have capital today, which is a giant if, there's very obvious opportunities.
Let me turn now to Miguel. You were mentioning, Miguel, that there's some absence in some countries, what the code says, what the local regulation specifies. Do you think that international trade agreements and people like many in this room that are enrolled in the LLM program that will return to their countries, that in some way that's de facto importing law into Latin American countries?
I think so, and I think we're now observing a very interesting phenomenon by the return of the last 20 years of LLMs to the region. For example, I had a very interesting situation negotiating the license of a software agreement to the Mexican Supreme Court. And all along, we have been told that certain U.S.-style provisions like merger clauses were not appropriate simply because the local codes did not recognize them. And there were even, I think, some Supreme Court decisions on that issue. But lo and behold, the draft we received from the Supreme Court to negotiate in terms of that license agreement was clearly a U.S. document translated into Spanish. So it was probably some LLM that was hired by the clerk of the Supreme Justice that thought it would be a good idea to call a friend here in Durham, and they borrowed an agreement that they nationalized, and then they shared it with us, and we were very happy to receive it. After we signed it, we exchanged ideas and thoughts, and that was the genesis of the document. But there's so much to be done on that front in terms of modernizing what I think is a very backward-looking legal system still. You mentioned the issue of forming a company. I wish that one day, I don't know whether I'll still be around, but maybe you guys will, that it'll be as easy to form a Mexican company as it is a Delaware company. Delaware company, you can do it with $100 with a phone call. And you have your company, and you can ask for your EIN in a day, and you have it. Come on, Mexico. You need to get a powers of attorney from your two investors, because for some funky reason we can't accept that a company can be owned by just one owner. We've got to deal with two. We've got to get powers of attorney. We've got to get them notarized here. Well, Mexico is not part of the Hague Convention, so we can get an apostille. Then that document that needs to be in two languages needs to be sent down to Mexico, reviewed, translated on the U.S. side and the Hague Convention apostille. Then you need to have a set of bylaws that need to follow the Mexican formality of a bylaws. And for that, you must have shown some English version to a client, so that's saying off of it. And then you need to take that document with your powers of attorney, assuming that you're not in a regulator area and that your name is not already taken by someone else that is called Acme Corporation, because then you have to deal with some other issues, and take them to these quasi-gods that I wish someday the DOJ sues them for antitrust practices called notary publics, that then take the magic wand and say, okay, Acme Company, you can form a company. And then after you do that you have your company, then you need to get your social security registration, your taxpayer registration. You go down the list. It's 6-8 weeks of painful bureaucracy, creating busy work for lawyers that is totally unnecessary. I've had my discussions with some public policy officials from the presidents on down in terms of why do we irritate foreign investors who want to build factories, hire employees, transfer technology, manufacture products with these nuisances. Liberate that process. The lawyers are not necessary for this process so long as you have, a decent regulatory registry body where you just, by affidavit, define what you're going to do so that you can get your corporate vehicle going. But I can go on and on with respect to the clashes of culture and legal detail that goes along with international investors. But the good news is that the trend is getting better. I think even though we still have remnants in terms of very, more than remnants, of very structured, 18th and 19th century practices, we're now seeing certain areas moving forward, adopting international standards, and perhaps the execution of trade agreements and investment agreements are leapfrogging that old legal structure and interposing one that's cross-border and international. And the interesting thing is that as we do that, we might be creating the new international commercial law that is a blend of systems, and where a new generation of lawyers will now become experts on how to interpret them, on how to use them, on how to implement them, and how to defend them. Argentina, interestingly, has been sued and challenged because of its bilateral investment agreements, and there's been interesting resolutions in Washington at the arbitral bodies that essentially blend both systems. So I think that's where we're going, but I'm hopeful that more students, open up their minds, exchange ideas, and then try to, improve systems here and there.
Now, I just want to follow up in one particular point that you were mentioning, and that's my experience as well, the time it takes to incorporate Sociedad Anónima or corporation in Latin America. I heard, and you tell me if you heard the same, that some law firms, they actually have some corporations ready to go for investors to purchase.
Yes, and the so-called shelf companies. But if your client is a publicly traded company, you want to do then due diligence on that shelf company to make sure that it's entirely on the up and clean. It might take longer to get that certification than go through the painful procedure of opening a new one. And unfortunately, all of these regulatory steps then generate the kind of temptation to cut corners that then become very relevant for you and the DOJ to review whenever there's bad behavior in Veracruz or in Sao Paulo or in Lima, where all of a sudden someone to expedite something, and I know there's an exception in terms of facilitated payments, et cetera, but it raises red flags. And by the way, many of the exceptions under FCPA are not exceptions under local law. So even small facilitating payment on the books, at least, can be seen locally if someone wants to create a problem as a bribe. So, it's, I don't know whether I answered your question, but
Sure,
that's my point on, in terms of, the process for getting started at shelf companies.
Thank you very much. Let me open it up. I can keep on asking questions. Love this topic. So let me see some hands there. I'm sure that there are some questions. I see there. Gonzalo in the back.
Yes, hello, how are you? I would like to know your opinion about what do you think American thinks about Latin America? What I think, do you still believe that they seen us as only one country, or do they make the difference between, okay, in this place there is rule of law, in the another place there is corruption? What do you think?
Well, I mean, I think certainly the best thing that ever happened to Brazil was being part of BRICS. That acronym, Brazil, Russia, India, China, because suddenly every every Fortune 500 CEO in the world needed to have a Brazil strategy. I mean, he knew going in as soon as that acronym got widely accepted that he was going to go into his board meetings, and before this crisis, his board was going to raise a hand and say, "What are you doing about Brazil, Russia, India, and China?" So every company needs to have a Brazil strategy. I think the big difference is that by and large, not 100%, but by and large, U.S. companies now have Latins in charge or having significant influence in their Latin American operations. I think companies have realized to be successful in Latin America, just like Asia, just like Russia, you have to play as a local. And 20 years ago, there wasn't that sensitivity, and quite frankly, I think it was great for the large economic groups in Latin America, because it was really easy. You just sell your company during a boom to a multinational, to Procter and Gamble or whatever. They'd mismanage the business for 3 or 4 or 5 years, and then at some point, when the economic cycle was down, they'd dump it back to who they had bought it from for not very much money. Now, that happens a lot less because the Procter and Gambles, really have Latins running the show.
Yeah, I think if I had to summarize it in one sentence, it's a region of opportunity. And to Juan Pablo's point, I think that there's been a tremendous changing attitude. I would probably, if I had to put a timeline or a landmark, it would be when Mexico and Chile took the lead in opening markets, dismantling import substitution models, and presenting the region as a place for expanding markets. And U.S. investors are quite astute. If they can do business in China, in Russia, they sure can do business in Brazil and Mexico. One would argue that it's a lot easier and more transparent and even quicker than in those markets that are much more complicated, more heavily regulated, and with less understanding of U.S. business culture in many ways. I would rather have a sophisticated business group from Brazil negotiating a JVA with me than a recently empowered multimillionaire from Moscow. Even if I own a soccer team that I want to sell to. Right? but that I think it's a place of opportunity that requires analysis, diligence, and appropriate game plan. But it is a place of opportunity.
All right, thank you so much. Appreciate it. Please join me with a round of applause.
Okay.
Before starting with our last panel, we would like to thank very much our speakers and moderators and give them a present for your participation. Thank you very much.
Okay, we're going to continue. We're going to continue right now. We're not taking a break, and I would like to introduce our next presenter. Actually, is the keynote speaker for the last segment of this program. I'm going to get out of the way here. Let me introduce briefly our new presenter. Luis Guillermo Echeverri is Executive Director at the Inter-American Development Bank, representing Colombia, Peru, and Ecuador. Additionally, Colombian representative to the boards of FOMIN, the Multilateral Investment Fund, and the International Investment Corporation. At Washington, D.C., he was appointed by and directly reported to the President of Colombia, Dr. Álvaro Uribe Vélez. Luis Guillermo Echeverri served as the Dean of the Board of Executive Directors during the period of 2007 to 2008, also served as Chairman of the Policy and Evaluation Committee of the Board of Executive Directors at the International Development Bank, responsible for negotiating with 46 countries the terms and conditions of the lending framework of 2005 to 2008 for 26 borrowing nations, representing a $32 billion structure. On behalf of Colombia, he enabled more than $7 million in public finance for the Colombian government from the International Development Bank, public sector, windows, and $500 million in private finance. From 2002 to date, has conceptualized, presented, and processed non-refundable cooperation projects for Colombia in excess of $120 million. And finally, from August 2002 to date, has brought to Colombia, and in many cases designed, developed, and implemented more than 147 non-financial technical cooperation, social, and economic development related events. Let me join in welcoming Mr. Echeverri.
Well, thank you very much. It's an honor to be here in Duke University, to be with you. I'm asked to talk a little bit about why to invest in Latin America, and I think this is a question of whether you want to put your money in Latin America, whether you want to put somebody else's money in Latin America, whether you want to be placed in Latin America. So before we see a little bit of that, and I share that with you, I would like to have a sense of who you guys are and who am I, and make this a little bit more of a warm conversation. I don't want to be just too technical. you heard wonderful presentations today, including Ivan, who works with me and can do all the technical work and better than me, and present more precise matters. I would like to get more into giving you a little bit more of what I really do, which is doing a lot of work throughout Latin America from a board of the IDB, which is the major cooperative lending money to the countries. It's a bank for countries. It's not a bank for people immediately, or for companies immediately, although we do a little bit of that as well. But from that perspective, it's difficult to tell you why to invest in Latin America, but it's simple at the same time. I would like to know how many of you are students here and speak Spanish. Okay, well, this is a good sense of this, and how many are law students and business students? Okay, well, good. And I assume the rest are teaching or teachers and lecturers here at Duke. So we'll try to do that. Is there any businessman here? No. Okay, good. Well, if any of you would like to interrupt me at any moment or talk with me, it'll be great, and it'll be okay to have a dialogue. I will try to tell you a little bit of my background. Has been very, very, very different. I'm not the normal banker or the normal lawyer. I'm a lawyer. I'm not the normal economist, and I'm an agricultural economist. But I do things as life tell me to do things, and I understand that life has cycles as well as the history and the economics. So sort of the person has to have, and if you're happy doing the same thing all your life, you're very happy doing that. I've been bound to do and change my life differently throughout my life. So I think I derive experience, and I derive the capacity to communicate and deal with issues with people and deal with issues through multiple experiences. And for those of you that are studying here and that come from Latin America, I will tell you, don't fear anything. Just go in life as you feel, and you'll do well. Why to invest in Latin America? I can think of this like from three perspectives. The first one is a geopolitical stand. The second one is the challenges that our civilization are having right now and what can result out of that. And the third one is the opportunities within Latin America. And I will say that in the geopolitical stand, you have great proximity to the biggest market, the market that has been, and we were talking before, the driver during the last century of the world economy, and now is putting it a challenge, but still is the biggest and more homogeneous market in the world, and the dynamic and the place where a lot of the technology evolves and comes out and has come out, and that proximity has not been exploited properly. The relationship north-south within our hemisphere is not as strong business-wise as the north-north relationship, and that has to do with disparity, but it gives an opportunity as well. So that proximity from that point of view, I think, is very important, as long as you know that you're focusing on that market and that you have an activity that is market-driven. I'm not saying that there cannot be activity from U.S. to sell into the Latin American market, because there's profound and huge proof of that going well as well. Both in the multinational environment, as well as in the small businesses of people that know the local culture and have created also those joint ventures that you were referring before, whether they are legally created or they are de facto joint ventures, and which they are, to me, they're very much interconnected, because once the de facto doesn't work, the legal has to come to a legal debate or to an end or to a solution legally. It's better to have it legally bound, but it has to work from the de facto embryo process that it has to go through. The cultural identity, I think, is a huge thing, and you all are proof of this. Now universities in the United States are full of people that can speak Spanish or are willing to speak Spanish, because the U.S. market is going to become the largest Spanish-speaking population by the year 2020, and that's a fact, and that's been affecting already the U.S. culture and the U.S. politics, and a lot of things in ways that we don't perceive as much in the daily life, but because we live here and we go by, but 10, 15 years ago, there were only few places in the United States where somebody will attend yourself in English and no more in Spanish. It was very, very rarely. Nowadays, on the service level in the United States, it's mostly Spanish-speaking people that take those jobs, and they will continue to go up and to claim the ladder within the U.S. Economic structure. That cultural identity and is very profound. The social relations, as opposed to other cultures, are bigger with Latin America and growing every day. The religion identity is there, although we're going through eras where there are differences in religions, but there are more differences with the Muslim culture and that relate to security in the world, and that gives us something more in common. The law, it can communicate. It's not the same. I will address that later, but from my own point of view. And also, there are two big markets. The U.S. is a 260, 250 million, developed. You can place sometimes Mexico with the North American group, sometimes not, whatever you want to look at. But in Latin America, you have 600 million. Now you need to understand that market, how it operates. It is not as homogeneous as it is the North American market. But the business culture already is being more about the same throughout the region and throughout the hemisphere. And obviously, we all try to live under the best democratic principles that we can have. And obviously, migration has been a great issue. Remittances have been very, very, very important up to this point, although it has, like everything, it pops up for one country and then come down as the people acculturate in North America. And then the universities and the level of education has continued to level up pretty much. We find a lot of countries where you find teaching in the universities and teaching at school becoming more bilingual, becoming more close, becoming more standardized and trying to get quality standards that are about the same. Though you need to understand that Latin America can no longer, and this was a question before, be considered one. And this is something that is a mistake that you see in most of the analysis that you see of the region. And I think part of the success of understanding geopolitically Latin America is understanding the diversity and trying not to fall into Latin America as a whole market. I think you got to understand every country, and as long as you can go even all the way down to municipal history, which is something very critical. And again, on that, you that are lawyers or you that are business people, you need to understand that you need people that know how business operate in every local community, but you need to know also how the law has behaved on that local community, because the standard is not enough. The international standard for law is not enough for you to do businesses or to represent well a business situation or your own capital. We have a lot in common in Latin America, but still we have big cultural differences that come from many things, starting by the latitude of our countries and the weather conditions and how our cultures evolve and what is our heritage, which countries have had English people settling there, which countries have European settlers, which countries have Arabian and Jewish settlers there, and how they evolve. It makes a whole of a difference on how that business community starts to live. So the sociological element in Latin America is something that is booming all the time. It booms because of the weather and the tropics, like everything changes over there. So the diversity of those countries like Colombia that are placed right in the tropics cannot give you an homogeneous anything, because at 200 kilometers, you have one city with one culture that is completely different to the other because there's a huge mountain range in the middle and because the communications not too long ago were very difficult between one place and the other. So, those things transcend, and although we're in globalizations, they're still there somehow. Now, energy is something that is very critical, and geopolitically, you got to understand there's a lot of energy in Latin America, not just oil, but a lot of the energy is going to be needed in the future. And also the biodiversity that lives there. And you need to understand whether you can find good leadership, and that's being formed, and I think that's getting better all the time in Latin America. Although a lot of people have migrated and a lot of talent, there's still a lot of people that are learning there, and particularly nowadays with the revolution of telecommunications, you have better people trying to solve and deal with the local issues better in Latin America as a whole. So I think that's critical. You got to understand, as I said, the legal system is not the same, and you need to find out the people that will do business legally and economically and financially with you, that understands the agreements. You mentioned, to finish this part, the trade agreements. I think they're absolutely necessary. Although you can protect or not for a time your economy, you need more uniformity of laws, and that's what basically a trade agreement gives you. You can have winners or losers. The ones that are prepared to export first and have the finance to do it will do better. But at the end of the day, what you do is you try to standardize the norms within two trading communities, and it's politicians trying to catch up with what already happened within businesses. So we should not be bothered so much as we are right now by that. Now, although I will say that Latin America has evolved, from very different models into a more open and free market nowadays than much before. The second perspective will be that of the challenges that we're facing nowadays. And I normally try to talk in this because there are problems and opportunities that people should think about it. I see it as a quadrangle that needs to be present in every balanced decision that we're making nowadays, whether they're legal, political, economic, financial. You need to understand that there's tremendous pressure from climate change, and I don't mean to be fanatic of Al Gore, but I need to recognize that is happening worldwide and it has big implications. I think energy is a resource that is going away, but it's not going to go away right away. There are many factors that will change these. If the Arab community and their investments in the north developed nations need to be protected as well. They will continue to pump, at which rate they're going to pump and how's that going to affect the prices. Are we going to have more volatility on the price of oil or not? That's going to determine a lot the inflation that we're going to face down the road and the terms of trade. Yes, of course. But, in due time, we will face problems with energy. Alternative energy has to come? Yes. Is it an easy road? No, not at all. People think it's easy. People think, you see it in the campaigns, you see windmills. That's not easy to implement. You need enough wind, constant wind. You need an economies of scale. Those things, to put them up, it costs a lot. You need to have all that critical mass to be able to make it feasible at the time that you need to understand how the oil prices and the coal prices are fluctuating and what's happening with that for you to have a feasible business. So it is not something that's going to happen overnight, and not all governments can subsidize alternative way of having energy. Obviously, coal and oil are resources that are going out, and at the same time, water is very critical, but you have to understand where water is. So Latin America, you have to place yourself. In the Andes, we have plenty of water. We don't use it well. We need to use it well. There's a lot of opportunities there for you guys, for a lot of companies that needs to understand better how this matrix or how this balance of things work out. And then you need food, and food needs agriculture. And food is a scarce resource nowadays, and we need to understand that very quickly. Water costs more than oil nowadays. I pay $3 or $4, sometimes more, at an airport for one of those bottles of water. Costs more than oil. It's tough to believe, but it does. And at the same time, in my country, I see it going away all day. We don't do anything about it. So there's tremendous opportunities about water. There are places of the world that don't have water with a lot of people, and they're going to need the water. So there will be a day where water is going to be transported like oil is transported nowadays. It will happen. And those are opportunities that are coming ahead. Same is happening with food, that, the world needs 30% more production of food throughout the next 20 days. It's not going 20 years. It's not going to happen 20 years from now. It's going to happen every day, little by little. And we have less fertile land to do agriculture. So, if you're representing somebody on that business, you better get, your hands on a piece of fertile land and try to do on that chain and be ready for what the opportunities are coming at the right moment. And I think right now is a good moment to start looking into those type of things. Crisis, push people to become entrepreneurs and to perceive opportunities. But the essence is that you need to balance those four things, so that development can be sustainable, so that the quality of life can be kept or can be improved where it needs to it, in means of poverty alleviation in our countries, so that markets and business can continue to move the economy and to give some more speed to it, and also to understand the power of a young growing population, which is one of the main assets that Latin America has, if not the main one, besides the resources. Now, if you look a little bit into the current crisis, I see that young students and people that are getting ready to go out and advise businesses or do their own businesses should look into what caused the crisis and understand that probably there will be changes that we're going to have to be facing. I believe that this is going to be, and I don't want to be negative, but this is going to be tougher than what we think it is. I believe this because I've seen small business suffering. Today we're gathering here in a university environment where, it is a lab. You test things, but it's not a real life out there. I see the malls without a lot of, for rent, and completely empty stores. I've seen, for the first time in my life, liquidation or things at Walmart. I never saw, rebates at Walmart, and I've seen them throughout the Christmas. So it gives me an indicator that if the United States is the boss, before we had crisis where we used to lose the job as countries, but now it's the boss that lost the job, or his business is not doing that well. So it worries me a bit for Latin America. It gives an open door for opportunities in the future. But this crisis is about consume and create. It's not only housing as it was sold at the beginning. That's only a component. We were talking about this today. The create, of course, the mismanagement of resources because of the euphoria of more money and more money in the system. I think Greenspan explains that better. But it is about behavior. People forgot about savings. People forgot completely about consumer behavior, and we enter into a mood where we needed to buy everything new every 2 months or 3 months, a new cell, a new CD player, a new something, and if the money was there or we could borrow it or put it in the credit card, fine. Is that okay? No. The mortgages is not only that we lend the system lend it irresponsible. It was also that a lot of people went to a second, third mortgage in order to pay the credit cards in the past, and that paid out for many years. I mean, it was dirt, and that we were putting and accumulating on a garage. All of a sudden, we opened the door. Yes, what came out? A crisis like this. But so it is something that I think behavior has to be adjusted for a while, and the economy, the real economy, will have to recycle a lot. It's been recycling, and this is why you see those massive employment losses in the United States and everywhere. And you see countries like Germany, the largest, the more efficient exporter of the world, full of technology, having a depression. And it is that part of how long the crisis is going to last, I don't know. But things will change for the better if we learn the lessons, or for those that learns the lessons that come out of a crisis. And I hope, that the crisis doesn't go away too soon, because it will mean more volatility. And I think, that's a case that, for example, for some of you that know well Argentina, have understood, that if a crisis, doesn't go deep enough, the volatility that continues, for example, it comes bigger. So, and also we can see that on the oil sometimes. And so that, I'm not preaching that it should stay for a while, because for our countries it will be worse. But I think it needs to go like an infection, as deep as it needs to go to clean up really the system and go away. I think we went, big time in the last 40, 50 years, but more than everything, we speed up very much on the last 10 years in civilization. We're a different world, and we need to understand right now. This is the first crisis of the globalization, but globalization as was presented to me is a little different. To me, globalization it has to do much more with us being interconnected. Is one world. It is we know more and we communicate more. Is that many of the same things can happen different places. That's what it means, and it is a fact. It's a fact that is very tough, but we need to live with it, and that's not going to be changed even if we come back to protective systems. Globalization will remain there. It will just mean that we have temporary policies that might be wrong or right, but the effect, once we had the internet, once we have telecommunications, once we have people that have not gone to classes like all of us and through universities and have masters or PhDs, just people that are cleaning buildings every night and working on a cafeteria during the day, those people have criteria nowadays. They are invaded by news, information, just as we are, and with the same type of information. Is whether we can be more analytical on a graph or not, what differentiates us from them. But don't think it's too much more. And those people are making decisions. And in Latin America particularly, those people became politically decision makers. And it's a reality. We're changing over there very dramatically because the world has changed too much in the last years. So it's a sequence of spreading knowledge, really what we've been living with problems on the economy because we spend a lot and because our pattern of consumption were not backed up by savings, and also I think because the service economy grew too much and the liquidity on the markets were too much that we confuse the function of the market as a cushion and as a short-term provider for businesses with a golden hen that laid golden eggs every day. And that was not the case. We needed to account for real assets as real assets and for services for the real value, which many times is very difficult to account for. Intangibles were accounted to a point, I will say, very much as real physical assets. And at least from my humble perspective of not sophisticated thinker, that was actually part of what happened in general. The issue of where are we living right now, I think we're living in a world that is less secure and where people need to survive and businesses need to survive. And obviously for this you need more information. And security needs to be on every sense of your life. You need to be able to live, to be able to eat, to cover yourself, to have a roof, health, a job, and that makes people be afraid of what we're living, of the times we're living, and sometimes make people more greed. But we need to understand that the environment, as I said, is critical for us. We need to understand what are the opportunities that lay out there, and how we're gonna work as lawyers, as business people, with the new cycles that are going to be presented to us. From the opportunities within Latin America, I will say that the diversity that we have bring great opportunities. Understanding, as I said at the beginning, each country and the way it's operating and how much acculturized that society is with the U.S. will give you the opportunity to introduce new business concepts into those markets. I will say fairly easy. Better if you have a local partner. I will say that if you want to do business with them in order to use this market as your marketplace, that's the best of the situations, but you need to have a secure market. So I think as compared to China, in business that are big volume, China and South Asia might be a very good source of products, but Latin American business have been overseen by many businesses in the U.S. as a place where you fly in 2 hours or 3 hours, a place where your business culture is the same, a place where you can communicate easier, a place where you don't need 2 or 3 executives to handle your business there if you're a mid-sized business in the United States, and a place where you can produce cheaper and many times on a reliable way. I think it's just a matter that you have to understand the diversity of countries to see where do you go for each thing. But we, as Latin Americans and the Americans, have not joined so many forces in order to understand better where those opportunities are. But throughout some years, I managed the Colombian Government Trade Bureau for North America and the Caribbean, and that was my job. I used to come to Ohio and find a guy that was a provider for Ford or General Motors that needed specific parts, and I put him together with a factory in Colombia. And the advice was, okay, put some money there. If you guys really get together and along, invest each other on the business, give a little bit of your business part to that guy here. And I've seen many of those going up through well. I won't say enough, but I will say there is a lot. And the numbers of trade between Latin America and the United States are comprised of those individual businesses that have found a market niche and a good coordination, and probably not the volumes that China or South Asia can provide, but the specific quality that a manufacturer here that can no longer afford just to have people in the U.S. Putting the same part on a whole assembled piece, doing every day can find it in Latin America. Same for services and professional services. I think there's a lot of opportunity there. Latin America as a whole has the possibility of become a more homogeneous market with the U.S. than everything. But we need to invest. We need to invest more in education and in infrastructure. So those are areas of opportunity. Education is booming in Latin America. The people are willing. Everybody that you see working in Latin America is willing to go at night to school and get education. Those that, like us, that have the privilege to come to this university sometimes overlook the efforts that people are doing in Latin America to get informed and to know things. They probably don't get this type of exposure that we have to businesses here, but truly they are doing a great effort to catch up. I think in logistics, market integration, trade services, financial services, and professional services, architecture, accounting, all that, you can find in Latin America niches where you can place or you can transfer the whole business, no fear, and get people, as this economy cannot afford to have all those massive jobs here, they can be in Latin America, and people don't have to come here to do accounting or to elaborate things on that require more than just a process plant. Again, also the alliance with Asia finishing the assembly of goods in Latin America, and particularly in the Caribbean, Central America, Colombia, on the Andean part, and coming into the U.S. market is an opportunity that is still there and is still very viable. And I will say that also in everything that relates to security, there still is a great opportunity in Latin America. And also in services, telecommunications, energy, as I mentioned before, intellectual property. I think tourism is something that is unexploited in Latin America in an organized way, that has been overlooked, and I think I know it has a potential that is great for many things, and particularly for that growing Hispanic population. Retirement is something that we've seen booming in Latin America. A lot of people that, and particularly on the crisis time, the good retirement with the things they aspire to have, maybe for some can no longer happen. That Florida base, but it can happen in Costa Rica, it can happen in Panama. It is happening, and that's part of the development that we have seen in some of the countries, or in some in the Caribbean as well. Challenges over there, plenty. I mean, political stability remains a problem, but it has improved on the average dramatically to my sense. The macroeconomic management in Latin America, I will say, is very good, and we really have a thermometer on that on the IDB. And the quality of the people that have managed the economy, they publish the way the countries are financing themselves, the way the expenditure is going on, is much better. I will say in that regard, it's only been progress and progress. Although you saw the graph that Ivan showed where some countries have spent more on social programs. I mean, that has a trade-off. If you do it well, your people will be better in the future. Probably your pocket is not be that good. If you just save it, well, you will have more to share, but are you going to do it well, or are you going to spend it on the crisis? It is a trade-off. Infrastructure has been improving, but there's a great opportunity for a lot of infrastructure there. And as I said, the average of Latin America has really leveled up to my standard understanding, although we remain with a lot of poverty. I will say is the case of Colombia is very particular. I will address questions on that in a minute if you want. We have approached security from a democratic security point of view, and this is a very profound thought of how to serve better the people, because it is physical security for all, beginning by the base, by the more poor, which are the ones that suffer more from violence and insecurity, from being more into the line of a better social cohesion, more equality, social guarantees and liberties to be respected, more transparency in managing everybody's assets and the public goods and assets, and also institutional independency. And those are, I think the elements that have worked well for Colombia to attract capital and to attract money during the last years. And all those, democratic security elements give you confidence. And this is the element that, for example, we're facing in the United States economy right now, is a lack of confidence on what's going to happen. And is the critical element for the economy to move ahead. Countries one by one are very different. Brazil has its own culture, has been more a closed type of economy that today is understanding that they need to invest abroad in order to keep their market share inside. This is very important to understand, so they are more open right now to international business, and their own domestic market is booming and growing. And Peru is a country that is doing absolutely well. Obviously it's going to be hit by the crisis like everybody else, but it's a country with more energy and that has overcome some of the problems that they have with democracy in the past, and are doing much better, particularly in the macroeconomic management of the country, and business are growing every day. Chile, you all know, is a country that's been doing very well. In Ecuador and Venezuela, there are transitions, but they come from people that know better and they want a change. They have endorsed probably the wrong or the right choice. I don't know what the outcome is going to be, but it looks difficult right now for investment, but we don't know what's going to happen down the road. Bolivia is trying to get together their act on a difficult way, but I think is a true path. Where are they going to be able to do it, or are going to be dissolved? Very difficult to say, but they have made progress, I will say, from our point of view, and definitely, it's a tough one because you have two countries there in a way, geographically, culturally. It's a very difficult combination, but I think we as a bank that mediates money on hand on problems have seen improvement in Bolivia, although some areas for investment have been tough. Paraguay is going through an experiment in politics that is part of democracy. We need to live with that, and obviously Argentina and Uruguay have problems that go very good together as their economies are correlated. But I see that they are countries with great future and where investment always have come, knowing which is the lower cycle and which is the upper cycle, and we all wish that we had a better political system in Argentina, but it has not arrived yet. We hope that it will arrive soon. The British Caribbean it has its own mentality. You need to separate it from the rest of the Caribbean. Mexico and Guatemala are going together. They're going through a rough time. They're facing a lot of the problems that Colombia were facing at the end of the 70s, early 80s, in terms of violence. And what happens is you had a system that used to go with corruption very much well, knowing their boundaries and living together. You have governments that have faced corruption. That creates a crash. And you need to see what comes out of the crash and how they're going to solve those issues. It's a tough one, but it is very related to the U.S. economy. And in that particular point of those issues that we all have in Latin America related to drug, which is the major problem to my understanding across the whole region, it's not just a Colombian or my hometown Medellin's problem. It is a problem, it's a global issue, and it's a global issue where co-responsibility has not been addressed properly yet, particularly by the countries that hold most of the demand. And in the meanwhile, our countries are demanding more drugs and using more drugs, and that's not good as well. So it is a problem that is like the weeds; they come out, and you gotta use everything on your hands and on your control to fight that. There's no magic formula for that. You need to be on the side of what is wrong or right, and try to continue to educate your population to one day be able to overcome this on a global way, and not just in a Latin American cut the supply position, which has been, unfortunately, the U.S. policy towards Latin American drugs. And it is an issue that is not addressed on the political debate in the United States, and it is an issue that the Latin population in the United States needs to address well with the policymakers here, because it lives everywhere. And then you have Salvador, Honduras, Belize. There are countries that are overcoming political unrest and violence and their own conflicts, but they have done relatively well. And Costa Rica and Panama, which are big receptors of investment, and have balanced better their social issues. And that's sort of a perspective of what geographically gives the region a very attractive place to put money if you are part of a hemisphere, if you believe that we can become an integrated market, if you understand that it's not the same going to California or going to New York to set up a business. Same happen in Latin America. So we need to make it different. If you are a banker in Florida, you're perceived different than a banker in Boston. I mean, it's a fact. You need to live with those differences here. You need to live with our difference in Latin America. So you need to call for attention on on the understanding of that municipal culture, I will say, not only the nation culture, because it varies within a country. I think those are basically the main thoughts that I wanted to address with you, to tell you at the end that you need to put your money where you enjoy that money. I think that's a principle if it is your own money. Don't make the mistake of putting it where you really don't enjoy it, and maybe, it will go away anyway. Or maybe it will come up big. I mean, so think about, the part of the satisfaction that you get out of it. If you're managing other money, you need to remember that you need to make very safe investments on the capital, because you're responsible for other people's money. And I think that's one of the biggest lessons that we can learn from the crisis we're going through. If people we're managing other people's money on a free ride and without thinking too much about it. But the most important thing of how to invest is where to place yourself. I think it is critical to think where you're going to place yourself in the future as you get out of the university and start working, and just never be sorrow for what you do. Just take a decision and go along as with it, and if you need to change, you need to start. I'm going to tell you a little bit of what I did and then open for questions. I grew up in Colombia in farms and herding cows and not paying too much attention to school, and started businesses when I was 13 and got broke many times and started again, and farming and trading animals in the fairs, and that sort of formation, and I loved it, and I didn't want it to leave. Then I went and I traveled international, and I came to the States, and I started to a life in sports, and I did well, and then I faced reality. I need to go to school, and then I end up in law school, and that was easy for me. I mean, I was able to to trick some of my professors on the oral exams and do well. I mean, but that wasn't what I wanted. I've been a horse tamer all my life, and end up doing something professional again with horses, and bullfighting on horseback for 11 years of my life, and that's what I really loved it, and I did it with passion, and it's not the money I made, is really the satisfactions that I remember and the years that I spent on that. So, I mean, pick up what you really want to do in life and try different things, and do the one that you really enjoy the most, and until it lasts. It came a day where I couldn't do it anymore because the situation in my country was so bad. And, I had the opportunity to go in politics or in businesses, and I didn't take it. I just thought I was going to, kill bulls and entertain people doing that. And I loved it. It was a very difficult thing and a very profound philosophy to take. It really taught me everything I know. So I took it until I couldn't do it anymore. And I couldn't do it anymore because I had a family to support. And then it was very difficult on those days in Colombia with the mafia and stuff like that. So I had to leave. I saw all my things burn out, and 3 generations of things burn out on a house. And I came here and started a new life. End up in Cornell, knock all the doors. I saw the people in the business school. I'm going to be very honest with you. I didn't like the environment. I saw the people in the law school. I already was a lawyer. I didn't like the lawyers, so I said, no, there's no place here for me too. So I ended up being an agricultural economist because, those people were open and they were dreamers and they thought of contributing to the world and thought about development economics and stuff like that. So I said, you know what, better with these people. And I tried. Out of that, became an agricultural economist, and I did a lot of work in food marketing and distribution and econometrics and things that I never thought I were going to do. So you don't limit yourself, because I did it. I did models and I did things like that. And I don't do it today, but I know the basics. Nobody's going to trick me with a model. Those are the things that change in your life. And then I went into consulting. I never left Colombia because I had that feeling that I needed to serve. So I did a lot of consulting work with the National Federation of Coffee Growers. Did a lot of analysis on agricultural economics on my country, where decisions were made very empirically or politically, let's say. wrong decisions most of the time. We try to contribute with that and negotiate. And I had exposure to travel through a lot of countries and see things through agriculture and to food businesses, which is the basic market, and where you really see people and how things move and how the economies are going to do well or bad. And I saw the transition of the U.S. from the gum and the McDonald's and the Burger King into sophisticated cuisine and all that, and how the U.S. transformed and evolved, and how we end up where we are nowadays on a middle class that got sophisticated and lives more like aristocrats. And I think that's part of the crisis. We need to adjust a little bit that again in order to start and save money so that money can be again a cushion in the market. I then ventured into trade promotion, managed the trade promotion agency of Colombia abroad for a few years. Then that was a political position. Those political positions, they end. And you need to change. You face the street one day, just like that. And so it is funny. So I started to do businesses across the Caribbean and sell everything, every possible thing that you think, from, tiles for the roof to sanitary towels, whatever you want. We did it in the Caribbean. And then thinking and trying to be creative, as the previous speaker was here, he was successful. He sold the company for a lot of money. I was part of the competition. I was with UP.com, but I was with the programmers on the back room developing a business-to-business application, and we had it sold, but then the market crashed. And the people from UP didn't want to sell. We couldn't realize the asset. But I learned a lot from that. And then I went into an information technology company. We were doing a little, better with programmers. I thought I needed to help people from my country. I didn't have a visa, so I put together a company and give them all a visa. And those were great workers, and we had a company together, and that was the reason of the business. But problem, we didn't have the capital to truly go ahead and hire managers. So I was the salesperson, the accountant at night, and everything at the same time. It doesn't work. But in this system at least, 9/11 came, and the small businesses in IT, it normally got tough for them, and we couldn't make it the way we thought. But I was able to put the food in my house, no matter what. And then one day, a good friend of mine called me and said, well, you're as we thought we spoke before, I got your father as my advisor, and I'm running for the president. I say, well, then I won't mingle with you guys in Colombia. I make it for sure. I don't want to be called anything that I am not, just for being there with you guys. So he said, well, you got to help me in the States. And I said, well, win the election first, and then I'll help you. And I was, doing software with my friends, and the president-elected called me and said, you know what, I have big financial problems, and I don't think it's take a banker to solve them. I think it just takes a person that knows how to manage people, because, it is people that are going to give me the okay on the money that I need. And so I need you to go to the IDV and take a look of it. What is it that we can solve over there? Because most of the money that I own to the IDV, and I need to refinance that money. And there I found Ivan, and we made a good team and an effort to understand what was going on at a bank like that, which is a close secret for the people that work inside. And we figured out that public finance is just like any other thing. Just don't lend to people, lend to countries. And so it's less transactions, more sophisticated projects maybe, but it is the same thing, and you just need to try to run a business sensibly, and at least represent the interest of both the bank and the country. So that's been my history to the point, and I'm ready to change in a couple of years when Uribe gets out of Colombia and do another thing. And I'm happy and ready. That's at least the best advice I can give you. So I wanted to share what I've done, so that you don't think that I just talk on an organized way of where to put your money in Latin America. It's just the outcome of my experience, and I welcome any question on a more serious way that you want to take.
Any questions from the audience?
Yes.
I'm thinking, what would be a recommendation for someone that's looking for a long-term investment in Latin America?
Well, I'll tell you, I love energy and water there. To me, they're critical. This is a source, a very tremendous source of gas in some countries, of hydro generation, for example, in countries like Colombia, in Peru and Ecuador, with huge potential. That's going to be needed for a long time. The market is beginning to be better regulated and is becoming a market share, is becoming integrated. I think that's a critical component of what we have to offer, at least in the Andes. It helps, as opposed to what the environmental, green people think. It helps to preserve the environment over there, and we need to preserve the Andes, and that's the type of investment we need to do to generate hydro there and preserve the forest, because if the Andes are not well preserved, the Amazon will die, and then the world won't have a lung, and that's going to be a problem. So I think in energy and water, managing water properly and doing water businesses over there and energy are critical component of what is to come. The other thing is the human capital. I will say that anything that you can do that your business require, people that you train and can do things for you from there, you have a human capital that is unbelievable. And I won't say just Colombia, I will say a lot of the countries in Latin America, understanding exactly in which area are you investing, but I will say that young people in Latin America are eager to learn and do jobs and get into more sophisticated types of jobs that could be a great long-term investment. I will say that just market may have some volatility in the short run. I will say there are established businesses down there that if you do have the market here, a great investment will be to buy them and produce there to send up here. Right? Because in the long run, the devaluation factor is going to be on your side, and I think is a winner. I've seen a lot of people for many years that identified well a market here, go down there, produce well, make sure that they have a sound joint venture, I think is still is a very, very valid proposition. Mining and transformation of metals, I think is another area with great potential in Latin America. It has to be a little sophisticated, but I think with technology and identifying the niches here of the needs, I think is at the same time you do a great favor to growth over there, because is killing in a way just to Latin America to export their raw material and go to China to come back here. I mean, in a way, what are you doing? Or to Korea or to South Asia. So those type of opportunities in a lesser scale, I think they might be very profitable and could be a long-term investment. That's from my point of view. I mean, on the financial side, there are other things, but like investing in the depth of some of the countries, I mean, but you need to understand that very well what you're doing.
We have another question here.
What do you think would be the relation between the new Obama administration and Latin America?
It's a tough one because, Obama is facing Washington now. He didn't know Washington that well, although he was there. But, it's different when you have to administrate Washington and live with Washington. I think, he might be more sensible to Latin America in a way, but, I still see that the United States doesn't place Latin America on the main list, unfortunately. I think that's a grassroots work that needs to be work at the U.S. universities, the work that you guys are doing, this type of organizations of joint efforts from students, from teachers, from scholars that love and understand Latin America. Their links with local businesses may bring more awareness to Washington, because one thing I've learned is that Washington doesn't get awareness from the international situations. Politics are always local. You need a U.S. citizen that has a U.S. legitimate interest to go and lobby with a politician in the United States. It doesn't work for us. And a proof of that is why we don't have a trade agreement right now. You know, we became part of the political debate. You're doomed for a while until that fever doesn't come down. You know, you're not gonna get anything in Washington. So that's the situation. I think there's also, you know, a comparison that I don't like to do too much, but I don't see anybody of color here in this room, unfortunately. But if you compare the average Hispanic born in the United States with the average Afro in the United States, they're doing better than the Hispanics. So I think there's a lot to do to get better position the Hispanics that are growing in the United States vis-a-vis the other groups. And it's sad to have to talk about this, but it's the reality in these countries. In our countries, where at least in some of us, in the tropical countries, we're more mixed. We don't have that marked differences within the segments of the populations, and they don't have that heavy weight on politics. So I've seen a little bit of you know, trying to sell us into not equality, but diversity. And I personally don't buy it too much. So I think there's a lot of work to be done. So awareness about Latin America and the potential and the importance of the businesses, because the overall numbers of trade with Latin America, if you include Mexico, are much more important than many others of the world. And if you don't include Mexico as well, they're very critical. And if you take it by regions, for Florida, you know, countries like Colombia or the Andean group is critical. It's a critical component of their trade and their wellness. Yes.
That you have mentioned for business in Latin America, and considering the current situation as it is, what would be your recommendations to better enable the business environment in Latin America? And if you can think of any recommendation that could have results in a shorter term, much better.
Any specific country or what?
Well, you can do it.
Because I know you speak. A regional focus. Well, I will say that democratic security, as I place it, is a key component, and it must become a state policy embraced by many of our countries, so that we can avoid those elements that threaten the free trade. You know, like labor issues, human rights issues, environmental issues. So the more coherent our democratic values become, the better relation we can have with the Northern Hemisphere. Now, to improve business, I think every day we're working on that. You know, our institution, for example, has a big fund that promote entrepreneurship, and we invest in improving those parameters of businesses. I will say that they were mentioning in the Chamber of Commerce of Medellin, my hometown, you can create from Tokyo a company in few minutes throughout the web, and you know, it's different than the case that was expressed in Mexico. But many people doesn't want to go to Medellin because they don't know the conditions there. So it's a matter of awareness as well. I will say that might be the key. The key is to bring more people from Latin America, to bring more people from North America to Latin America to be aware of what's going on down there. I will say that's what improved the business environment. And that what has proved, at least to me, to work better, because you bring people to a trade show here or in a road tour, and you bring them to a busy environment of the person that is buying or is running a business. You know what? Yeah, they give them 10 minutes, 30 minutes, you know, it's okay. One time in a life, I won't see this soccer anymore. You know, that's one thing. You bring that guy to Latin America, whether he spends on the ticket or whether you take him and give him the ticket. Well, you know, he said, well, I'm going to be here for 3 days. I better get friends with these people. And, you know, he starts to do business as he does with the other Joe around here, you know, and they end up being friends. And you know what? He starts to like some of the things that he see down there. And all of a sudden, you have a business going on. So the critical component is for chambers of commerce, for business groups, for universities to encourage the traveling to those places. And at the corporate level, the business developed with Asia and with China and everything happened for two reasons. Because the Asian people came here and took a look of the model and then started to invite people. Come here, we'll show you. And if this is not perfect, tell me what I need to do. And surprise you, I will do it in a week. So, let's start business until it happens. I think the same has to be made. It's just that our governments don't invest as much as they should on inviting the business community. We probably invest a lot in lobbyists in Washington and stuff like that. And I personally sometimes see it as a waste of money. But anyway, that will be my answer. Very general. I don't know if I answer you. Well,
Thank you very much. Please join me.
Thank you.